If you want to learn how to trade options professionally, this is the course for you. In this video, we're going to build the full framework serious options traders use to understand and trade the product properly. We'll start with the foundation, what an options contract actually is, how calls and puts work, how options are priced, and how to think about an options value, the Black-Scholes framework, and the Greeks. Then we'll move into the heart of professional options trading, volatility. We'll cover implied versus realized volatility, how volatility is measured, why options are really volatility products, and how the volatility surface, skew, and term structure shape the price of every trade you put on. After that, we'll move into the part that actually determines whether you can make money doing this. Market efficiency, expected value, risk premia, and what real trading edge actually looks like in a brutally competitive market. And finally, we'll take all that theory and turn it into real trading. Real options chains, real margin considerations, real strategy analysis, and real examples around volatility trades. Most options content online stops at surface level direction. It tells you to buy a call if you're bullish, buy a put if you're bearish, maybe memorize a few strategies, and that's it. This is not what this is. This course is about learning how options actually work and how they're actually priced and how professional traders actually think about volatility, risk, and edge. Everything is timestamped in the description, so if you want to skip around or revisit a topic later, you can do that easily. And if you want to follow the material in a progressive format with written content, examples, and quizzes, we have the full course structure on OQuants for free at the link in the description. So if your goal is to think like a professional, build real understanding, and learn to trade options at a much higher level, let's start at the foundation. What are options? At its core, an option is a type of derivative contract. The term derivative simply means its value is derived from an underlying financial asset, such as a stock, an index, or a commodity future. The contract itself represents an agreement between two parties, a buyer and a seller. It provides the buyer, also known as the holder, with the right, but not the obligation, to either buy or sell a specified quantity of the underlying asset at a predetermined price on or before a specific future date. This distinction, the right, not the obligation, is the cornerstone of an option's value and strategic utility. To acquire this right, the buyer pays a non-refundable fee to the seller, also known as the writer. This fee is called the premium. The premium is the seller's to keep, regardless of whether the buyer ultimately chooses to exercise their right. In exchange for receiving this premium, the option seller accepts a conditional obligation. If the buyer decides to exercise their right, the seller is legally bound to fulfill their end of the bargain, either selling the underlying asset to the buyer or purchasing it from them at the agreed upon price. This is important to remember. As a buyer of an option contract, you receive the right, but not the obligation to exercise a contract, hence the name option. However, as a seller, you are obligated to fulfill the contract if the buyer chooses to exercise. The buyers hold the privilege of an option, while the sellers are required to fulfill the buyer's privilege. Options come in two fundamental types that form the basis of all strategies: calls and puts. Understanding their distinct characteristics, risk profiles, and payoff structures is the first critical step for any aspiring trader. Each type can be either bought, a long position, or sold, a short position, creating four primary starting points. A call option grants its holder the right, but not the obligation, to buy an underlying asset at a predetermined price, known as the strike price, on or before a specified expiration date. The seller of a call option is obligated to sell the underlying asset at the strike price if the buyer chooses to exercise their right. A trader initiates a long call position by buying a call option. This is a bullish strategy used when a trader anticipates a significant increase in the underlying asset's price. The maximum risk is limited to the premium paid for the option. If the stock price does not rise above the strike price by expiration, the option will expire worthless, and the entire premium is lost. The potential reward is theoretically unlimited. As the stock price rises, the value of the call option continues to increase with no upper bound. The payoff formula at expiration is equal to the maximum of either 0 or the stock price at expiration minus the strike price minus the premium paid. Let's assume a trader buys one call option on stock ABC with a strike price of $100 for a premium of $3. Since one contract controls 100 shares, this is known as the option multiplier and is almost always 100 shares for stocks and ETFs, but can vary, and we will cover this later. The total cost is $300, or the premium times the multiplier. The break-even point for this trade is the strike price plus the premium, $100 plus $3, for a total of $103. If stock ABC closes at $110 at expiration, a favorable move, the option is in the money. The trader exercises their right to buy 100 shares at $100 and can immediately sell them at the market price of $110. The gross profit for this trade is $110, or the closing price of the stock, minus our strike price, or $100, times the multiplier, for a total of $1,000. The net profit is the gross profit minus the premium paid, or $1,000 minus $300, for a net profit of $700. If stock ABC closes at $95 at expiration, an unfavorable move, the option is out of the money. The right to buy the stock at $100 is worthless when it can be bought for $95 on the open market. The option expires worthless. The loss is limited to the premium paid for a total of negative $300. If stock ABC closes exactly at the strike price at $100, the option is at the money and has no intrinsic value. It expires worthless. The loss is limited to the premium paid, which again is negative $300. A trader initiates a short call position by selling or writing a call option. This is a bearish or neutral strategy used when the trader expects the underlying asset's price to stay flat, decrease, or rise only modestly. The seller collects the premium upfront and is obligated to sell the underlying asset at the strike price if the buyer exercises the option. The potential risk is unlimited. As the stock price rises, the seller's losses mount with no ceiling, as they are obligated to sell stock at a strike price far below the market price. The maximum reward is limited to the premium received when the option was sold. This is achieved if the option expires worthless. The payoff formula at expiration is equal to the premium received minus the maximum of either 0 or the stock price at expiration minus the strike price. The scenarios for the short call option are the same, just reversed. That is, a gain in the long case would be a loss in the short case, and vice versa. If you want to nail down your understanding, think through these examples for the short call using the same scenarios we covered for the long call. A put option grants its holder the right, but not the obligation, to sell an underlying asset at the strike price on or before the expiration date. The seller of a put option is obligated to buy the underlying asset at the strike price if the buyer chooses to exercise their right. A trader initiates a long put position by buying a put option. This is a bearish strategy used when a trader anticipates a significant decrease in the underlying asset's price. It is also commonly used as a hedging instrument to protect a long stock position from a downturn. The maximum risk is limited to the premium paid. If the stock price does not fall below the strike price, the option expires worthless. The potential reward is substantial but capped. The stock price cannot fall below 0, so the maximum value of the put is the strike price. Therefore, the maximum profit is the strike price minus the premium paid. The payoff formula at expiration is equal to the maximum of either 0 or the strike price minus the stock price at expiration minus the premium paid. Let's assume a trader buys one put option on stock ABC with a strike price of $100 for a premium of $3. Again, with a multiplier of 100, the total cost is $300. The break-even point is the strike price minus the premium, or $97. If stock ABC closes at $90, a favorable move, the option is in the money. The trader exercises their right to sell 100 shares at $100, even though the current market price is $90. The gross profit is the strike price minus the stock price at expiration, or $90, times the multiplier. This gives us a total of $1,000 gross profit. The net profit is the gross profit minus the premium paid for a total net profit of $700. If stock ABC closes at $105, an unfavorable move, the option is out of the money. The right to sell stock at $100 is worthless when it can be sold for $105 on the open market. The option expires worthless. The net loss is limited to the premium paid, which is negative $300. If stock ABC closes at $100 at the strike price, the option is at the money and has no intrinsic value. It expires worthless. The loss is limited to the premium paid, which is negative $300. A trader initiates a short put position by selling a put option. This is a bullish or neutral strategy used when a trader expects the underlying price to stay flat, increase, or decrease only modestly. The seller collects the premium and accepts the obligation to buy the underlying asset at the strike price if assigned. The risk is substantial, but not unlimited. The maximum loss occurs if the stock price falls to 0. In this case, the loss is the strike price, as the seller must buy the worthless stock at the strike, minus the premium received. The maximum reward is limited to the premium received. This is achieved if the option expires worthless. The payoff formula at expiration is equal to the premium received minus the maximum of 0 or the strike price minus the stock price at expiration. Again, the scenarios for the short put are the same, just reversed. That is, a gain in the long case would be a loss in the short case, and vice versa. If you want to nail down your understanding, think through these examples for the short put using the same scenarios that we covered for the long put. Now that we have explored the 4 basic option positions, we must break down what an options premium is actually composed of. The premium you pay or receive for an option isn't just a single abstract number. It is the sum of 2 distinct components: intrinsic value and extrinsic value. Understanding this distinction is absolutely fundamental. It explains why an option that is currently worthless can still command a high price, and why an option's value erodes over time. We can express the total option premium as being equal to intrinsic value plus extrinsic value. Intrinsic value is the straightforward, tangible value of an option if it were exercised today. It is the amount by which an option is in the money. If an option is at the money or out of the money, its intrinsic value is 0. It can never be negative. For a call option, intrinsic value is the amount the stock price is above the strike price. Intrinsic value for a call can be expressed as the maximum of 0 or the stock price minus the strike price. For a put option, the intrinsic value is the amount the stock price is below the strike price. The intrinsic value for a put is the maximum of either 0 or the strike price minus the stock price. Let's consider an option on stock ABC with a strike price of $100. If ABC is currently trading at $105, a $100 strike call option is $5 in the money. It could be immediately exercised to capture this $5 difference. Its intrinsic value is therefore $5. A $100 strike put option is out of the money. If theoretically exercised, you would sell the stock at $100 when it is currently trading at $105, resulting in a $5 loss. However, since you have the option to not exercise, its intrinsic value is 0. If ABC is currently trading at $97, a $100 strike call option is out of the money. If theoretically exercised, you would buy the stock for $100 when it is currently trading at $97, resulting in a $3 loss. However, since you have the option not to exercise, its intrinsic value is 0. A $100 strike put option is $3 in the money. It could be immediately exercised to capture this $3 difference. Its intrinsic value is therefore $3. Extrinsic value is any amount of the premium that is not intrinsic value. It is the intangible part of the options price. It is often called time value, but this is slightly incomplete as it is driven by 2 main forces: time to expiration and implied volatility, which we will cover shortly. Extrinsic value represents the market's price for the possibility that the option could become profitable or more profitable before it expires. It is the value of uncertainty. Extrinsic value can be expressed as the option premium minus the intrinsic value. Let's revisit our ABC $100 strike call option while the stock is currently trading at $105. We know the intrinsic value of this call is $5. Let's assume the option is actually trading in the market for a premium of $6.50. The extrinsic value is calculated as $6.50, or the premium, minus $5, or the intrinsic value, leaving $1.50 of extrinsic value. This $1.50 is the extrinsic value. It is the price a buyer is willing to pay for the remaining time on the contract and the chance that the stock might rise even further above $105 before expiration. A seller receives this $1.50 as compensation for taking on the risk of the stock moving further against them. At the exact moment of expiration, there is no time left and no uncertainty about the final price. Therefore, all extrinsic value disappears, and an option's price becomes equal to its intrinsic value. This is why an out-of-the-money option becomes completely worthless at expiration. At-the-money options have the most extrinsic value. Options that are at the money have the highest degree of uncertainty about whether they will finish in the money or out of the money. Consequently, they command the highest extrinsic value, all else being equal. Out-of-the-money options are only extrinsic value. Options that are out of the money have no intrinsic value. If they were exercised today, they would be worthless, and so are composed of only time plus volatility value, the potential for future intrinsic value. Extrinsic value is what erodes every single day due to the passage of time. This daily erosion is what we will later define as theta, one of the option Greeks. When you buy an option, you are paying for extrinsic value, and this value is a decaying asset. When you sell an option, you are collecting this decaying extrinsic value up front. Now that we understand the components of an option's price, it's time to see where this all comes together in the real world. The option chain is the central interface for all options trading. It is a list of all the available option contracts for a given underlying asset, organized by expiration date and strike price. Mastering the ability to read and interpret the option chain is the critical step that bridges theory and practice. Initially, it can look like an overwhelming wall of numbers, but it follows a very logical structure. Let's break down a typical options chain for a fictional stock currently trading at $152.50. At the very top of the chain, you'll typically find a list of available expiration dates. These are presented as tabs or a drop-down menu. In the US market, standard options expire on the third Friday of each month, but most actively traded stocks also have weekly options expiring every Friday, and even longer-term options known as LEAPs or long-term equity anticipation securities that can expire years in the future. Selecting an expiration date will load all the available option contracts for that specific date. In our specific example, we are looking at the April 17th expiration, which is 32 days away, sometimes known as 32 DTE or 32 days to expiration. The chain is split into two halves, centered around the list of strike prices. Calls are typically on the left. All information related to call options is displayed on the left side of the chain. Puts are typically on the right. All information related to put options is displayed on the right side. Strike prices are down the middle. The strike price column is the central axis of the chain, listing all available strike prices in ascending order from top to bottom. Each row in the chain corresponds to a specific strike price, and the columns provide the critical data for the calls and puts at that strike. The chain is usually color-coded to show which options are in the money. For calls, these are strikes below the current stock price. For puts, these are strikes above the current stock price. The bid is the highest price a buyer in the market is currently willing to pay for that option. If you want to sell an option immediately, you will likely receive the bid price. The ask is the lowest price a seller in the market is currently willing to accept for that option. If you want to buy an option immediately, you will likely pay the ask price. The bid-ask spread is the difference between the bid and the ask prices. It represents the direct, built-in cost of trading and is a key indicator of liquidity. A narrow spread, for example, a $2.50 bid and a $2.55 ask, indicates high liquidity. A wide spread, or a $2 bid and a $3 ask, indicates relatively low liquidity. Placing a market order here is very dangerous, as you could pay much more than your theoretical fair price. This brings us to a very important rule. Always use limit orders to trade options. The last is the price at which the last trade for this specific contract occurred. This can sometimes be misleading if the last trade happened hours ago or even days ago. So always focus on the current bid and ask. The volume is the total number of contracts that have been traded today. This tells you how active the option is right now. High volume is a sign of strong current interest. Open interest is the total number of outstanding contracts that have not yet been closed, exercised, or expired. This is a measure of total market participation and is the best indicator of an option's overall liquidity. An option with thousands of contracts in open interest, far more liquid and reliable than one with only a handful. By understanding these components, you can look at any options chain and quickly assess the price, liquidity, and general market interest for any contract you are considering trading. Options possess a unique duality that allows them to serve two distinct, almost contradictory functions: as a vehicle for high leverage speculation and as a tool for conservative risk management. Leverage is the ability to control a large amount of an asset with a relatively small amount of capital. Because an options premium is typically a fraction of the underlying asset's price, options provide immense leverage. This allows traders to amplify their potential returns and the percentage loss on their initial investments from a correct forecast of market direction. Imagine a stock XYZ is trading at $100 per share. An investor who believes the stock will rise could buy 100 shares for a total capital outlay of $10,000. If the stock rises to $110, their profit is $1,000. A 10% return on investment. Alternatively, the investor could buy a call option, giving them the right to buy 100 shares of XYZ at $100 strike price for a premium of, say, $5 per share. The total cost for this option contract would be $500. The $5 premium times the 100 share multiple. If the stock rises to $110, the option will now be worth at least $10 per share, its intrinsic value, making the contract worth $1,000. The investor can sell the option for a $500 profit or 100% return on their investment. This magnification of percentage returns is the power of leverage. Of course, if the stock did not rise above $100 by expiration, the entire $500 premium would be lost, representing a 100% loss. As we can see, leverage works in both directions. Gains are magnified, but so are losses. We can see it here on a graph. The option return moves much quicker in response to price changes than an underlying stock position, demonstrating the leverage embedded in the instrument. To the upside, the return on investment increases much more quickly than the stock position. In the same way, the option position quickly falls to a negative 100% loss, where the stock position would show only a small loss. It's very important to remember that leverage cuts both ways. Conversely, options can be used to protect existing positions from adverse price movements, much like an insurance policy. A portfolio manager holding a large stock position can buy a put option to establish a floor on the value of their holdings. The premium paid for the puts is analogous to an insurance premium, representing the known fixed cost of protection against an unknown, potentially large loss. An investor holds 100 shares of XYZ, currently valued at $100 per share, for a total value of $10,000. They are concerned about a potential market downturn ahead of a major economic announcement, but they do not want to sell their shares. They can buy one put option with a strike price of $95 for a premium of $2 per share, or a total cost of $200. This gives them the right to sell their 100 shares at $95 regardless of how far the stock price might fall. If XYZ drops to $80, their stock position has lost $2,000, but their put option position is now worth at least $1,500, its intrinsic value. This offsets a significant portion of the loss. The $200 premium was the cost of this downside protection. By looking at the graph, we can see how this behaves. The put combined with stock sets a floor on the loss of the stock. This does not come for free, however. We can see that the premium of $200 reduces the upside by this $200 amount. We can also see that the max loss is the difference between the strike and the current stock price minus the premium, or $700 in this case. To the keen-eyed viewer, the stock with the protective put looks oddly like the graph of a call. And in fact, this position is referred to as a synthetic call. We will cover synthetics briefly later in the course. The terms of an option contract specify when the holder can exercise their right. This leads to two primary exercise styles. With American style, the holder can exercise the option at or any time up to and including the expiration date. This flexibility is a key feature of most US single stock or ETF equity options. With the European style, the holder can exercise the option only at the expiration date. This style is common for cash-settled index options, such as those on the SPX or NDX. Why does this matter? The right of early exercise in American-style options can, under certain conditions, for example, deep in the money options or pending dividend payments, provide an additional strategic advantage. This right has value, and thus an American option will always be worth at least as much as an equivalent European option, and often more. We will explore the concept of optimal early exercise in a later section. Upon exercise, the terms of the contract must be settled. This happens in one of two ways. With physical delivery, the actual underlying asset is exchanged. When a call option on a stock is exercised, the call holder pays the strike price in cash and receives the shares. For a put, the holder delivers the shares and receives the strike price in cash. This is the standard for single stock and ETF options. With cash settlement, no underlying asset changes hands. Instead, the in-the-money amount, or the intrinsic value, the difference between the strike price and the official settlement price of the underlying on the expiration date, is transferred as cash from the seller to the buyer. This is the standard for index options, as delivering all the component stocks of an index would be impractical. Every option is defined by a standard set of specifications. While some of these may seem minor, a misunderstanding of any one of them can lead to costly errors. First, the underlying asset, the specific security or asset which the option is based. For example, Apple stock, the S&P 500 index, or crude oil futures. The strike price is the fixed price at which the holder has the right to buy for a call or sell for a put the underlying asset. The expiration date is the final date on which the option is valid. After this, the contract ceases to exist. The type, whether the option is a call or a put, the exercise style, whether the option is American or European, the settlement method, whether the option is settled via physical delivery or cash, and the contract size or multiplier, which specifies the quantity of the underlying asset controlled by a single option contract. For US equity and ETF options, this is almost always 100 shares. For futures and index options, it can vary. It is crucial to remember that option premiums are typically quoted on a per share basis. The total cost of a contract is the quoted premium multiplied by the contract size or multiplier. It is crucial for an options trader to understand that the terms of a contract are not entirely static. The financial landscape of a company can change through various corporate actions, and option contracts are adjusted accordingly to ensure that no value is unfairly created or destroyed for either the buyer or the seller. The guiding principle of any adjustment, as managed by the Options Clearing Corporation or OCC, is to keep the contract's overall value unchanged immediately following the event. The most common corporate actions that trigger adjustments are stock splits, reverse splits, special dividends, and mergers. A forward stock split occurs when a company increases its number of shares outstanding to make the share price more accessible to investors. For example, a 2-for-1 stock split. Imagine you own one call option contract on stock XYZ with a strike price of $120. The stock is currently trading at $150 per share. Your contract gives you the right to buy 100 shares of XYZ at $120. When XYZ executes a 2-for-1 split, every shareholder receives 2 shares for each one they previously held, and the stock price is halved. The stock will now trade at $75 per share. To ensure your option position remains economically equivalent, the OCC adjusts the contract as follows. The strike price is halved to $60, and the multiplier, or the number of shares the contract controls, is doubled to 200. Before the split, one contract controls 100 shares at $120 strike. The total notional value at the strike is 100 shares multiplied by the strike price, or $12,000. After the split, one contract now controls 200 shares at a $60 strike price. The total notional value at the strike is now 200 shares times the $60 strike price, or $12,000. Your position remains the same in terms of its total value and intrinsic worth. The right to buy 100 shares at $120 is economically identical to the right to buy 200 shares at $60 after the split. A reverse stock split is the opposite, where a company reduces its number of outstanding shares to increase its stock price. These adjustments are similar to the forward stock split, but opposite. That is, the strike is increased and the multiplier is decreased. For example, let's look at a 1-for-5 reverse stock split. Suppose you own one put option contract on stock ABC with a strike price of $10. The contract represents the right to sell 100 shares at $10 each. The stock is currently trading at $2 per share. After a 1-for-5 reverse split, the stock price increases 5-fold to $10 per share. Your option contract is now adjusted to reflect this change. The new contract will now control only 20 shares, and the strike price will be increased 5-fold to $50. The total value remains consistent. While regular expected cash dividends are typically priced into options by the options market and do not cause an adjustment, large, unexpected special dividends do. In these cases, the strike price of the option is generally reduced by the per share amount of the special dividend on the ex-dividend date. However, traditional dividends do introduce early assignment risk, which we will cover later. Adjustments for mergers are highly specific to the deal's terms. Depending on whether the deal involves cash, stock in the acquiring company, or a combination, the option may be adjusted to become an option on the acquirer's stock, possibly with a cash component attached to the deliverable. In all cases, traders should rely on official memos from the OCC for the definitive details of any contract adjustment. These memos precisely outline how contracts will be modified to maintain a fair and orderly market. Unlike stocks, of which there is a finite number of shares, options are created and extinguished by traders' actions. The total number of outstanding contracts, known as open interest, expands and contracts based on market activity. When you initiate a trade, you are either buying to open, if you are the option buyer, or selling to open, if you are the option writer. This action creates a new contract if your counterparty is also opening a position. To exit your position before expiration, you execute an offsetting trade. If you initially bought an option, you would sell to close. If you initially sold an option, you would buy to close. Most retail options traders close their positions in the market rather than holding them to expiration to avoid risks associated with exercise and assignment. The final moments of an option's life are governed by a clear set of rules for exercise and assignment. While most traders close their positions before this stage to manage risk, understanding the mechanics of expiration is essential, as it dictates the ultimate outcome for any contract held to their final day. If an option is held through expiration and is in the money, it will typically be automatically exercised. This automatic exercise occurs even if the option is in the money by as little as 1 cent. An option is in the money if its strike price is favorable relative to the stock's official closing price on the expiration date. A call is in the money if the stock price is above the strike price, and a put is in the money if the stock price is below the strike price. When a long option holder's position is exercised, a short option seller must be chosen to fulfill the obligation. This process is called assignment. The OCC uses a non-discriminatory method, typically a random lottery, to assign the exercise notice to a brokerage firm whose clients are short that specific contract. The brokerage firm then assigns the notice to one of its clients who is short the option. Upon assignment, the two parties must settle the contract. The transaction always occurs at the option's strike price, regardless of the stock's current market price. This process happens after the market closes on the expiration date, with the resulting stock and cash positions typically appearing in the respective accounts on the following business day, usually Monday morning. Let's examine the outcome for each party. Let's first look at a long call exercise. You are the holder of one long call option on stock XYZ with a $50 strike price. At expiration, XYZ closes at $55. Your call is in the money and is automatically exercised. Your brokerage account will show a purchase of 100 shares of XYZ stock. Simultaneously, your cash balance will be debited by $5,000, or the $50 strike times the 100 share multiplier. You now own the stock and can hold it or sell it at the prevailing market price. Let's look at scenario 2 for the short call assignment. You are the seller of one naked or uncovered call option on stock XYZ with a $50 strike price. At expiration, XYZ closes at $55. You are assigned on your short call position, and you are now obligated to sell 100 shares of XYZ at the $50 strike price. Since you did not own the shares to begin with, also called an uncovered or naked position, your broker will facilitate the delivery for you. This results in a short position of 100 shares of XYZ appearing in your account. Your cash balance will be credited by $5,000, or the $50 strike times the 100 share multiplier, and you are now short the stock and exposed to the risk of further price increases. You will eventually have to buy the shares back on the open market to close this short position. Now let's look at scenario 3 for the long put exercise. You are the holder of one long put option on stock XYZ with a $50 strike price. At expiration, XYZ closes at $45. Your put is in the money and is automatically exercised. This gives you the right to sell 100 shares at $50. Assuming you hold 100 shares of XYZ, those shares will be removed from your account. In return, your cash balance will be credited by $5,000, or the $50 strike price times the 100 share multiplier. If you did not own the shares, exercising the put would automatically create a short stock position of 100 shares. Let's look at scenario 4 for the short put assignment. You are the seller of one put option on stock XYZ with a $50 strike price. At expiration, XYZ closes at $45. You are assigned on your short put position. You are now obligated to buy 100 shares of XYZ at the $50 strike price, even though they are only worth $45 on the open market. 100 shares of XYZ stock will be purchased and placed in your account. Your cash balance will be debited by $5,000, or the $50 strike price times the 100 share multiplier. You now own the stock at a cost basis of $50 per share and have taken on the full risk of a long stock position. While buying an option requires the full payment of the premium upfront, certain option structures, particularly those involving selling options, require margin. Margin is a good faith deposit or collateral that a trader must maintain in their account to guarantee they can meet their potential obligations. Selling an uncovered call, for example, has theoretically unlimited risk, and the broker will require a significant amount of capital to be set aside as margin to cover the potential losses. However, margin is usually significantly less than it would cost to buy an amount of shares equal to the contractual obligations. For instance, Interactive Broker's margin requirement of a short call is approximately equal to the premium of the option plus 10% of the underlying value. Understanding and managing margin is critical for optimizing a portfolio's capital efficiency. a topic we will delve into much deeper in later sections. While factors like the underlying price and strike price are easy to understand, the most important and most nuanced driver of the options price is volatility. If there's one concept that a trader must internalize to move beyond the basics, it is this. When we trade options, we are fundamentally trading volatility. The directional view on a stock is often secondary to the view on the magnitude of its future price swings. If you are trading options, you are trading volatility, period. What is volatility? In finance, volatility is a statistical measure of the dispersion of returns for a given security or market index over a specific period. Critically, it is directionless. It quantifies the degree of price movement, not the direction of that movement. In more technical terms, volatility is typically expressed as the annualized standard deviation of logarithmic returns of the underlying asset. While we will perform a deep dive into the importance of volatility in section 2 of the course, for now, it is sufficient to think of it as a measure of uncertainty or risk. A high volatility implies that an asset's price can change dramatically over a short time period in either direction. Low volatility implies that the price is not expected to move significantly. Options derive their value from the possibility of a favorable outcome, because a long option holder has limited risk, or the premium paid, and in the case of a call, unlimited potential reward. The value of the option is intrinsically linked to the probability of large price moves. Think of an option premium as the price paid for a range of potential future outcomes. The greater the uncertainty about the underlying's future price, the wider the range of potential outcomes, and therefore, the more valuable the option becomes. All else being equal, an increase in expected future volatility will increase the premium of both calls and puts. A higher chance of large price swings increases the probability that the option will finish deep in the money. This enhanced potential for a large payoff must be reflected in a higher upfront premium. As a buyer, you must pay a higher premium when the market anticipates greater potential for movement, because your potential profit has increased. You are buying the chance of a large move. As a seller, you must demand a higher premium to compensate you for taking on the increased risk associated with potentially larger adverse price moves. You are selling insurance against a large move and must be paid more when the perceived risk is higher. For the call graph, the key idea is that only the prices above the strike actually create value at expiration. If the stock finishes below the strike, the call expires worthless. So whether it lands a little below or a lot below does not change the payoff. It is still zero. That is why extra downside probability does not help a call. What matters is the probability mass to the right of the strike, especially far right, where the call becomes worth much more. When volatility increases, the distribution widens, and more probability is pushed into those higher priced outcomes. Since a call's payoff keeps getting larger as the stock rises, those bigger upside possibilities raise the call's expected value today. In other words, higher volatility makes the chance of a large, profitable move more realistic, and that added upside potential is what makes the call premium more expensive. Another important point is that volatility is not directional. It does not push the stock upward or downward. It simply spreads the entire distribution of possible future prices outward in both directions. A low volatility stock has a narrow distribution, meaning most outcomes stay clustered near the current price. A high volatility stock has a much wider distribution, meaning there is more probability of both very low prices and very high prices relative to the current underlying price. But a call option only cares about one side of that wider distribution, the prices above the strike. Everything below the strike still leads to the exact same expiration value of zero, whether the stock finishes slightly below or collapses far below. So when volatility expands the distribution, the added downside possibilities do not increase the call's value, but the added upside possibilities do, because those are the outcomes where the call can become worth a lot more. That is why higher volatility raises the call's expected value and therefore its premium. The put graph works the exact same way, just in reverse. Again, higher volatility widens the distribution symmetrically, creating more probability of both large upside moves and large downside moves. But a long put only benefits from the left side of that wider distribution. The price is below the strike. If the stock finishes above the strike, the put expires worthless. And it does not matter whether the stock ends a little above or very far above. The payoff is still zero. So the extra upside probability created by higher volatility does not help the put. What matters is that the wider distribution also creates more probability of large downside outcomes, where the put becomes increasingly valuable. So volatility does not increase option prices because it has a bullish or bearish opinion. It increases option prices because it expands the whole range of possible outcomes. And the option only counts the side of that range where it can actually make money. An option can be conceptualized as a wager on where a stock will be at a future time. The passage of time allows for stock prices to move, and volatility determines the potential magnitude of that movement. In this sense, volatility can be viewed as a form of synthetic time. A high volatility stock with 1 month until expiration may have a very similar range of potential outcomes to a low volatility stock with 6 months until expiration. Increasing either time or volatility expands the distribution of possible future stock prices, which, for an option holder, increases the chance of a large payoff and thus increases the option's value today. The key takeaway is that time and volatility impact the terminal price distribution in very similar ways. And for all intents and purposes, an increase in time or volatility will have similar effects on an option's value and risk measures. A fundamental concept in professional options trading is the crucial distinction between two types of volatility. Implied volatility, also known as IV, is the market's consensus forecast of what the volatility of the underlying asset will be between now and the option's expiration date. It is the level of volatility that is implied by the current market prices of an option. It is forward-looking. Realized volatility, or RV, is the volatility that the underlying asset actually experiences over a specific period. It is a historical, backward-looking measure of what has already happened. The core of most sophisticated options trading lies in forecasting future realized volatility and comparing it to the current level of implied volatility. The market's forecast, IV, is not always correct. We will analyze this more in depth later in the course, but for now, the following generalities apply. If you believe the market is overestimating future price swings, meaning IV is greater than our forecast of RV, you would look for opportunities to sell options, collecting what you believe to be an overly expensive premium. If you believe the market is underestimating future price swings, IV is less than our forecast of RV, you would look for opportunities to buy options, paying a premium that you believe is too cheap relative to the potential move. Because volatility is such a critical dynamic component of an option's price, we need a precise way to measure an option's sensitivity to changes in it. This, along with the sensitivity to other factors like price and time, leads us directly into the indispensable model known as the Black-Scholes-Merton model. To build a robust framework for trading, we must move from intuition to quantification. The Black-Scholes-Merton, also known as BSM model, represents the landmark achievement in this effort, providing a mathematical foundation for option pricing that revolutionized finance. While modern trading has evolved far beyond the model's simple assumptions, its language and core concepts remain the bedrock upon which all professional option analysis is built. Developed by Fisher Black, Myron Scholes, and Robert Merton in 1973, a work that would later contribute to a Nobel Prize in Economic Sciences, the BSM model was the first widely accepted and mathematically rigorous framework for valuing a European-style option. It provided a closed-form solution, a direct formula that could calculate a theoretical fair value for an option based on 5 key inputs. Its publication coincided with the creation of the Chicago Board Options Exchange, or CBOE, and together they ushered in the modern era of derivatives trading. At a fundamental level, an option's price must depend on a small set of observable inputs: the current underlying price, the strike price, the time remaining until expiration, and the prevailing risk-free interest rate. The final input, and usually the most important one in practice, is volatility. This brings us to the famous Black-Scholes-Merton model. As traders and practitioners, we do not need to go deep into the full derivation to use it well. What matters most is understanding, at an intuitive level, what the model is actually doing and why volatility matters so much. The BSM formula gives us a closed-form way to estimate the fair value of a European option using the above inputs. In practical terms, you can think of the model as taking today's known inputs and translating them into a distribution of possible prices at expiration. From that distribution, it estimates the option's payoff across all those possible outcomes, takes the average expected payoff, and then discounts that value back to today. That is the core intuition. The option's price today is the present value of its expected payoff at expiration. So the model is effectively asking, Across all possible stock prices at expiration, what is the average payoff likely to be, and what is that payoff worth in today's dollars? This is where volatility becomes so important. Higher volatility means a wider range of possible future prices. For a stock, a wider distribution is not automatically better or worse by itself, but for a call option, the payoff is asymmetric. The downside is capped at 0, while the upside can become very large. That means when volatility increases, the probability of very large positive payoffs increases, while the downside remains limited. As a result, a wider distribution raises the expected value of the option. So even if two scenarios have the same expected future stock price, the one with higher volatility can still produce a more valuable option. That is one of the most important ideas in options pricing. Another practical reason this model matters is that once we price an option, we can also measure how sensitive that price is to each input. By changing one input at a time and observing how the model price responds, we can calculate the option's Greeks, the key risk measures that tell us how the option price changes with stock price, volatility, time, and rates. We will cover those in detail next. So for now, the main point is that the model gives us both a price and a framework for understanding the risks behind that price. If you want the full mathematical derivation and a deeper explanation of where the formula comes from, check out my separate BSM video on the channel. For this course though, what matters most is that you understand the intuition. The model takes today's inputs, maps out possible prices at expiration, converts those into possible options payoffs, and discounts the expected payoff back to the present. That intuition is more important for trading than memorizing the derivation. In modern practice, the BSM model is rarely used to determine what an option should be worth. The market, through forces of supply and demand, decides an option's price. Instead, the model's primary function is inverted. Traders use the known market price of an option and work backwards with the BSM formula to solve for the one unknown variable, volatility. The resulting figure is the implied volatility, or IV. This is the model's most powerful application today. It takes the complex, fast-moving, and often noisy world of options premiums across hundreds of different strikes and expirations and translates it into a single, relatively slow-moving, and comparable parameter. It allows a trader to say, the market is currently pricing the 30-day options on this stock with an expectation of 25% annualized volatility. This provides a standardized language to compare the relative cost of options across time between different assets and against historical data. Implied volatility is useful because raw option premiums are not directly comparable across different stocks. For example, an $8 at-the-money call on a $400 stock is not automatically more expensive than a $5 at-the-money call on an $80 stock in any meaningful trading sense, because the stocks themselves are different sizes and their options prices depend on all the inputs we mentioned. And in fact, the options on stock B are actually significantly more expensive, speaking in implied volatility terms. By converting each market premium into implied volatility, traders compress all of that complexity into a single standardized number, the market's volatility expectation. That makes it much easier to compare options across names, expirations, and time, because you can quickly tell whether an option is actually rich or cheap relative to another one, rather than being fooled by the raw dollar premium. In practice, IV gives traders a common language for screening trades, spotting relative value, and making faster decisions without constantly recalculating what a premium should mean for every different stock. In general, a professional options trader will refer to the price of an option in terms of IV. The core idea behind the BSM model is no arbitrage. If an option's payoff can be replicated by trading the stock and cash, then the option must have the same value as that replicating portfolio. This insight is powerful because it means we do not need to forecast the stock's expected return or drift in order to price the option. In the BSM framework, the drift can be completely hedged away through dynamic rebalancing, so it drops out of the pricing equation. As a result, options pricing is not driven by your view on whether the stock will go up or down, but mainly its volatility. We will revisit this idea later when we cover delta hedging, where you'll see how dynamic hedging reduces directional exposure and isolates volatility exposure. To arrive at its elegant closed-form solution, the BSM model relies on a set of simplifying assumptions about how markets behave. These assumptions create an idealized world, and the model's practical usefulness comes largely from understanding where that world differs from reality. In many cases, those differences are exactly where risk and opportunity appear. The model assumes the volatility of the underlying asset is known and remains constant over the life of the option. In reality, this is one of the model's biggest shortcomings. Implied volatility varies across strike prices, producing the volatility smile or skew, and across expiration dates, producing the term structure. If the BSM model were perfectly correct, all options on the same stock would imply the same volatility. The model assumes the underlying can be traded continuously and that prices evolve smoothly without sudden jumps. In practice, markets do not move continuously. Stocks gap overnight, can jump sharply on earnings, news, or macro events, and these jumps matter because they break the ideal continuous hedge that the model relies on. The model also assumes that stock prices follow a log normal process, which implies that log returns are normally distributed. Real markets do not behave this cleanly. Returns tend to exhibit fat tails and skew, meaning extreme moves occur far more often than the model predicts, especially on the downside. The model also assumes that the interest rate used for discounting is known and constant. In reality, rates move over time, borrowing and lending rates can differ, and market participants do not all face the same financing conditions. The model also assumes trading is frictionless, with no commissions, no bid-ask spreads, and no taxes. In the real world, hedging is costly. These frictions make continuous rebalancing imperfect and reduce the practicality of the model's ideal replication argument. And finally, the standard BSM formula applies only to European-style options, which can be exercised only at expiration. Most single-stock equity options are American-style, meaning they can be exercised early, so the basic model does not fully capture that additional feature. For all these reasons, the BSM model is often described as wrong but useful. It does not describe the market perfectly, but it provides a foundational framework for understanding option pricing, volatility, and hedging. Later in the course, we will revisit these shortcomings in more detail and show how traders adapt when the model breaks down. The BSM model is an indispensable tool, not a trading strategy. It is a map, but it is not the territory. Its value does not come from its ability to output a correct price. Its true contribution is providing a standardized framework and language, implied volatility, to analyze and compare option prices. The model allows a trader to look at the entire volatility surface and ask intelligent questions. Is the market's current implied volatility a fair price for the volatility I expect the stock to actually realize in the future? Why are downside puts priced at a higher IV than upside calls? Is this skew too steep or too flat relative to history? Why are short-term options priced at a higher IV than long-term options? Is this relationship justified? These are questions we will analyze later on and show how situations like these can lead to profitable trades. We will explore how to ask and answer these questions later in the course. The edge in options trading comes from correctly answering these questions. It is found in judging whether the market's collective forecast, as encapsulated by implied volatility, is right or wrong. It is found by exploiting relative value mispricings between different points on the volatility surface. The BSM model does not give you the answers, but it provides the language necessary to ask the right questions. But the main takeaway of this section is that the model allows us to turn complex option prices, depending on many inputs, into a single, slow-moving, and comparable parameter. They also allow us to calculate our risk exposures, known as the Greeks. An option's value is a dynamic entity, constantly repriced by the market as its underlying components shift. To manage a position effectively, a trader cannot simply place a trade and hope for the best. They must understand and quantify how their positions will change and react to these changes. This is the role of the Greeks. They are the language of risk, providing a framework to measure an option's sensitivity to the various factors that influence its price. The Greeks are a set of risk measures, each named after a Greek letter, that are derived from an option pricing model like the BSM model. Each Greek isolates a specific dimension of risk, quantifying how much an option's theoretical value is expected to change for a 1-unit change in the corresponding input parameter. It is absolutely critical to understand what the Greeks are, and more importantly, what they are not. They are not a predictive tool or a trading strategy in themselves. The Greeks do not, under any circumstance, offer a trading edge, but they are indispensable as risk management tools. As Sheldon Natenberg emphasizes in Option Volatility and Pricing, they are best viewed as the dashboard gauges in a high-performance car. Delta is your speedometer, showing your instantaneous directional exposure. Gamma shows you how quickly that exposure can accelerate. Vega is the fuel efficiency gauge for volatility, and Theta is the steady drain on that fuel tank, representing the cost of the journey. A skilled driver uses this information to navigate safely and effectively. A skilled trader uses the Greeks to manage their risk exposures and precisely align their position with their market thesis. An edge in trading comes from having a better forecast than what the market has priced in. Specifically, a more accurate forecast of future realized volatility compared to the market's implied volatility. The Greeks simply describe the vehicle you have chosen to express that view. The term derivative can sound intimidating, but it describes a very simple and powerful idea: measuring the rate of change. A derivative tells you how much one thing changes with respect to a change in something else. The key is to think of it as a sensitivity or responsiveness number. Let's use the intuitive analogy of driving a car. Think of your car's exact location on a long straight road. Let's say you are at mile marker 100. This is your current state. The first derivative, called velocity or speed, comes from your car's speedometer reading. It measures your change in position, miles, with respect to your change in time, hours. If your speedometer reads 60 miles per hour, that is the derivative. It tells you that for every 1 hour change in time, your position is expected to change by 60 miles. Now, what happens when you press the gas pedal? Your speed changes. Acceleration is the measure of how much your speed, the first derivative, changes with respect to the change in time. It is the derivative of the derivative. It tells you how sensitive your speedometer reading is to the passage of time. When we say a Greek measures something with respect to something else, we are simply identifying which sensitivity we are looking at. Theta is the sensitivity of the option's price with respect to time. Vega is the sensitivity of the option's price with respect to volatility. Thinking in terms of these sensitivities demystifies the calculus and grounds the Greeks in a practical and intuitive question. If this input changes by a little bit, how much should I expect that output to change? We will cover the 5 main Greeks: delta, gamma, vega, theta, and rho, the most direct and important risk exposures of any option position. We will also cover second and third order effects for the basic Greeks. I don't think it's important that you learn their names, but it is important that you understand how the primary Greeks change relative to other inputs. Delta is the first derivative of the option price with respect to the price of the underlying asset. It measures the expected change in an option's price for a $1 change in the underlying. It is the single most important Greek for understanding an option's directional exposure. A delta of positive 0.6 means that for every $1 increase in the stock price, the option's price is expected to increase by 60 cents. A delta of negative 0.3 means the option will lose 30 cents for every $1 the stock rises. Call options have a positive delta, ranging from 0, which represents far out of the money options, to 1, which represents deep in the money options. Put options have a negative delta, ranging from 0 for far out of the money options to negative 1 for deep in the money options. Delta serves 3 primary practical applications. First, the equivalent stock position. The total delta of a portfolio reveals its net directional exposure. A position with a delta of plus 150 is, for small price changes, equivalent to owning 150 shares of the underlying asset. A position with a delta of negative 25 is, for small price changes, equivalent to being short 25 shares of the underlying asset. It also acts as the hedge ratio. Delta precisely defines the number of shares required to create a delta neutral hedge, a position with no immediate directional bias. To hedge a portfolio with a delta of negative 75, a trader must buy 75 shares of stock. This is because stock has a delta of 1, which results in a net delta of 0. It is also sometimes used as a probability proxy. While not mathematically identical, delta is commonly used by traders as a rough back-of-the-envelope proxy for the probability of an option finishing in the money. An at-the-money option will typically have a delta near 0.5, which implies a roughly 50-50 chance of finishing in the money. The delta is not static and changes relative to other inputs. As time to expiration or implied volatility increases, the distribution of potential ending stock prices widens. This has a different effect on an option's delta depending on its starting point. For an out-of-the-money option, a wider distribution is purely beneficial. It increases the probability that the stock could travel the distance needed to finish in the money. Therefore, its delta will move from near 0 towards 0.5. For an in-the-money option, a wider distribution introduces more uncertainty. While it could finish even deeper in the money, it now also has a higher probability of falling back and finishing out of the money. This increased chance of failure causes its delta to move from near 1 down towards 0.5. For a precisely at the money option, these two effects are balanced, and its delta remains stable around 0.5. Gamma is the second derivative of the option's price with respect to the underlying price, or more simply, the first derivative of delta. It measures the expected rate of change in an option's delta for a $1 change in the underlying asset. If a call option has a delta of 0.5 and a gamma of 0.10, a $1 increase in the stock price will cause its delta to increase to approximately 0.6. Gamma is always positive for long option positions and negative for short positions. Gamma is the measure of the convexity or instability of an option's price. It is the engine of optionality. Positive gamma for long options is a highly favorable characteristic. Your directional exposure accelerates in your favor and decelerates against you. When the stock moves in the desired direction, your delta increases, magnifying gains. When it moves against you, your delta decreases, mitigating losses. You pay a premium through theta to own this favorable risk profile. Negative gamma, for short options, is an inherently unfavorable risk profile. Your directional exposure works against you. When the stock moves against you, your delta becomes more adverse, accelerating your losses. When it moves in your favor, your delta shrinks, slowing your gains. You receive a premium through theta as compensation for taking on this risk. The behavior of gamma is most pronounced for at-the-money options, and its sensitivity accelerates dramatically as expiration approaches. Far out of the money or deep in the money options have relatively low gamma. Deltas are already close to their natural limits of either 0 or 1, and their changes in delta are therefore not very sensitive to small changes in the stock's price. Gamma's value is highest for short-term options because as expiration nears, the option's potential outcome becomes increasingly binary. It will either finish in the money with a delta of 1 or out of the money with a delta of 0. This impending binary outcome forces the delta to become extremely sensitive to price changes around the strike, which causes a massive spike in gamma. This is precisely why traders refer to short-term at-the-money options as gamma options. Their value and risk profile are dominated by this convexity. A crucial, often overlooked nuance is that gamma is inversely proportional to the underlying stock price. An option on a $50 stock will have a higher gamma than an equivalent option on a $200 stock. This is because gamma is measured per 1 point move in the underlying. A $1 move represents a much larger percent change for a $50 stock than for a $200 stock. Because the percentage impact is greater for the lower price stock, its delta must adjust more dramatically for each point move, resulting in a higher measured gamma. This contrasts with Vega and Theta, which tend to be larger in absolute dollar terms for higher priced underlines. The gamma is not static and changes relative to other inputs. Since gamma itself is second order, these effects are actually third order. It changes as the underlying asset moves. This sensitivity of gamma to changes in the stock price is a third order Greek called speed. Gamma is most stable when an option is at the money or far out of the money or far in the money. At these points, its sensitivity to price changes, speed, is at its lowest. Gamma is most sensitive to price changes when an option is either moderately out of the money or moderately in the money. Specifically, speed is highest for options with deltas around 0.15 and 0.85, or negative 0.15 and negative 0.85 for puts. This is the zone where gamma is accelerating or decelerating most rapidly as the option moves toward or away from being at the money. We can notice this in the gamma bell curve. The rate of change of gamma is lowest and is actually 0 or flat at the peak of the curve, or at the money. And visibly it has a lower slope and is changing less near the tails of the distribution. Gamma also changes in response to time to expiration and the level of implied volatility. Relationships captured by higher order Greeks like color, which measures the rate of change of gamma with respect to time, and zoma, which measures gamma's sensitivity to volatility changes. The magnitude of these effects depends on where the option is trading relative to its strike price. For an at-the-money option with a delta near 0.5, gamma increases as expiration gets closer or as volatility falls. Think of it this way: low volatility or little time remaining forces the option into a binary decision. Its delta must rapidly choose between becoming 0, i.e. worthless, or 1, i.e. in the money. This instability makes the delta extremely sensitive to the smallest price change, which is the definition of high gamma. For options that are distinctly in the money or out of the money, the opposite is true. For these options, gamma generally decreases as time to expiration or volatility decrease. We can quantify these ranges using delta. Out of the money options, that is those with deltas around 0.15, and in the money options, that is those with deltas around 0.85. Given more time or higher volatility, gives these options a greater chance of moving towards the strike price, where gamma is naturally at its peak. This added uncertainty makes their gamma profile more robust and responsive to changes in time and volatility. As time passes or volatility falls, there is less of a chance of the underlying moving towards the strike, and thus the deltas will approach 1, fully in the money, or 0, fully out of the money. Theta is the first derivative of the options price with respect to the passage of time. It measures the expected erosion in an option's value for each day passed, assuming all other factors remain constant. It is the measure of time decay. A theta of negative 0.05 means an option is expected to lose 5 cents of its value each calendar day. Theta can be thought of as the rent paid to be long gamma, or rent collected to allow someone else to be long gamma. It is important to note that theta is not an edge. This is arguably the most misunderstood concept among novice and intermediate traders. Theta is not a source of profit or edge. Theta is simply the payment for gamma. Within the BSM framework, there is a direct and inseparable relationship between gamma and theta. You cannot have one without the other. If you are long an option, you own positive gamma, a favorable trait, and therefore must pay for it through negative theta. Time is your enemy. If you are short an option, you have taken on negative gamma risk, a very unfavorable trait, and are therefore compensated for this risk by receiving positive theta, where time is your friend. If we knew that options were priced fairly and IV was a perfect representation of future realized volatility, there would be no edge or zero expected value in buying or selling options, regardless of whether theta is paying you or not. Many traders believe they have an edge by systematically selling options to collect theta. This is a very dangerous oversimplification. In reality, they are not trading theta. They are implicitly making a forecast about volatility. They are betting that the future realized volatility of the stock will be lower than the implied volatility currently priced into the options. This systematic difference between implied and realized volatility is a well-documented phenomenon known as the variance risk premium, or VRP. A successful strategy of selling options is not an exploitation of theta, but a successful harvesting of the VRP. This is a distinct and sophisticated strategy that we will explore later. The crucial takeaway is that the edge, if it exists, is in a successful volatility forecast, not in the theta itself. This is not to bash those traders. The importance of understanding where your edge is coming from and not relying on oversimplifications, because it will get you burned eventually. Theta is largest for at-the-money options. This is because at-the-money options have the most extrinsic value, which erodes as expiration approaches. The closer an option is to expiration, the faster this decay becomes, leading to a sharp rise in theta for at-the-money options in their final days of their life. Additionally, theta tends to be higher for options on higher priced underlying stocks, all else being equal. Higher priced stocks result in higher option premiums, and thus there is more extrinsic value available to decay over time. A key relationship exists between theta and gamma. As expiration nears, gamma increases for at-the-money options, reflecting greater sensitivity of delta to price changes. This heightened gamma risk is balanced by a faster loss of time value, resulting in an increase in theta. In essence, the rising cost of gamma exposure near expiration is offset by the accelerated time decay captured by theta. Volatility plays an important role in theta as well. As implied volatility increases, option premiums, and therefore extrinsic value, become larger. This higher extrinsic value leads to a greater amount of time decay, causing theta to rise. In other words, when volatility is higher, options lose value more quickly over time because there's more premium at stake that must erode as expiration draws near. Vega measures the expected change in an option's price for a 1 percentage point change in implied volatility. An option with a Vega of 0.15 will gain 15 cents in value if its IV increases from 25% to 26%. It is positive for long options and negative for short options. Vega is not actually a true Greek letter from the original BSM derivation, which assumes constant volatility. However, in the real world of trading, it is arguably one of the most important Greeks for a professional. It is the direct measure of your exposure to the primary variable you are often trying to forecast, volatility. Vega is highest for at-the-money options. Crucially, unlike gamma, Vega is higher for longer dated options. An option with 1 year to expiration is far more sensitive to a change in long-term volatility expectation than an option with 1 week to expiration. This makes long-dated options the preferred vehicle for pure volatility plays. It is why long-term options are often referred to as Vega options. Vega changes as the underlying asset's price moves. The sensitivity of Vega to a change in the stock price is captured by a higher order Greek known as Vana, which measures the rate of change of Vega with respect to changes in the underlying price. Interestingly, Vana can also describe how delta changes as volatility changes, because mathematically, both interpretations are equivalent. Vana tends to be most significant when options are slightly in or out of the money, where changes in the underlying price or volatility meaningfully affect both delta and Vega. Another important higher order Greek is Volga, also called Voma. Both are contractions of volatility gamma, which measures how Vega changes with respect to volatility itself. Volga describes the curvature of an option's value as volatility changes. Essentially, how quickly Vega rises or falls as volatility increases or decreases. For at-the-money options, Vega is relatively stable and changes very little as volatility shifts, leading to a Volga near zero. However, for options that are significantly in or out of the money, Volga becomes more pronounced. As volatility increases, the deltas of in the money and out of the money options gravitate towards 0.5, causing these options to behave more like an at the money option and increasing their Vega. Thus, in the money and out of the money options exhibit higher Volga, with peaks occurring for calls with deltas around 10 and 90, and puts of deltas around -10 and -90. Vega is also affected by time to expiration. As time to expiration increases, Vega rises because there's more time for volatility changes to influence the option's price. This relationship is captured by the derivative known as d Vega d time, also called Veta or Vega decay, which measures the sensitivity of Vega to the passage of time. The Vega of long-term options changes more slowly, while the Vega of short-term options can decline rapidly as time decays, particularly for options with deltas of around 10 and 90. Rho measures the expected change in an option's price for a 1 percentage point change in the risk-free interest rate. An increase in interest rates will increase the value of calls and decrease the value of puts. The logic relates to the carrying cost of the replicating portfolio. For a call, higher rates increase the cost of borrowing to hold the underlying stock, making the right to buy later more valuable. For a put, higher rates increase the interest earned on the cash received from shorting the stock, making the right to sell later less valuable. The cost to borrow the underlying stock acts like a negative dividend and has the opposite effect. For most short-term strategies, Rho's impact is negligible. It becomes relevant only when dealing with long-dated options or in a macroeconomic environment with significant, rapid changes in interest rate policy. For all intents and purposes, it's usually the least important Greek. In the final days and hours of an option's life, the smooth, continuous world described by the standard Greeks breaks down completely. Their utility as risk indicators diminishes rapidly, and a different mindset is required. For an at-the-money option, gamma approaches infinity as expiration nears. Its delta will swing violently between 0 and 1 on the slightest tick in stock price change, making traditional delta hedging impossible and prohibitively expensive. At the same time, its theta also explodes, with the option losing nearly all of its remaining time value in the final hours. Risk management must shift from a continuous view, managing delta and gamma, to a binary one. The primary question is no longer, what is my delta exposure? But rather, will this option be exercised or not? The dominant risk becomes pin risk, the uncertainty of where the stock will close relative to the strike, and the resulting assignment risk. A trader's focus must be on managing the potential for an unwanted, large overnight stock position, not on hedging the minute changes in the delta that has become almost meaningless. The Greeks are simply a set of risk metrics. They quantify how an option's price is expected to change based on shifts in the market's underlying factors. They do not offer a trading edge. The edge comes from having a better forecast than what the market has priced in. The Greeks are the tools used to precisely structure a position to express that forecast. Delta is your directional exposure. It measures the option sensitivity to a $1 change in the underlying price. It is your equivalent stock position. It moves towards 1 for in-the-money options and 0 for out-of-the-money options. It serves as a quick and dirty proxy for the probability of finishing in the money. Higher volatility or more time to expiration tends to increase the absolute delta of out-of-the-money options and decrease the absolute delta of in-the-money options, because both increase uncertainty about the underlying's expiration price. That makes out-of-the-money options more likely to finish in the money, and in-the-money options more likely to finish out of the money, pulling deltas towards 0.5. Gamma is your exposure to acceleration. It measures how quickly your delta changes when the stock price moves. Positive gamma from long options is a favorable trait where directional exposure increases on favorable moves and decreases on adverse moves. The opposite is true for short gamma from short options, where it is an unfavorable trait. It is at its highest for at-the-money options near expiration and with low implied volatility. Theta is the cost of optionality and your payment for gamma. It is the daily decay in an option's value due to the passage of time. It is the direct payment for owning gamma. Long options have negative theta. They are paying to own gamma. And short options have positive theta. They are getting paid to provide gamma. It is important to remember that theta on its own is not an edge. Profit from selling options comes from the variance risk premium, or VRP, the phenomenon where implied volatility is systematically higher than the volatility that is actually subsequently realized. The edge is in the volatility forecast, not the time decay itself. It is at its highest for at-the-money options near expiration and with low implied volatility. Vega is your exposure to changes in implied volatility. It measures the sensitivity to a 1% change in implied volatility. This is your direct exposure to shifts in the market's forecast of future price movement. Long options have positive Vega and gain value if IV goes up and lose value if IV goes down. And likewise, short options have negative Vega and lose value if IV goes up and gain value if IV goes down. It is highest for at-the-money long-term options. More time allows for more uncertainty, making these options most sensitive to volatility changes. Instead of memorizing all the rules, understand that all Greek behaviors stems from the probability distribution of future stock prices. At-the-money is the point of maximum uncertainty. For any given expiration, gamma, theta, and vega are all at their highest for at-the-money options. This is the inflection point where the option's outcome is most uncertain. It will either move in the money or out of the money, making it most sensitive to changes in price, time, and volatility. The effect of time is twofold. As expiration approaches, the future becomes more certain and the range of possible outcomes narrows. This decreases vega. However, this certainty forces a binary outcome for at-the-money options, causing their gamma and theta to skyrocket. This creates the strategic distinction. Near-term options are gamma instruments, and long-term options are vega instruments. Certainty diminishes risk. The Greeks fade to near zero for options that are far out of the money or deep in the money. Their outcome is all but certain. A far out of the money option has almost no chance of becoming valuable, and a deep in the money option will behave almost identically to the stock. There is little uncertainty left for the Greeks to measure. The central idea is that ultimately all Greek behavior can be inferred by visualizing the distribution of potential future prices. Factors that widen this distribution, more time or higher volatility, give out of the money options a better chance to become valuable, and in the money options a greater chance to fail. The Greeks simply quantify how sensitive your position is to this shifting shape of the probability distribution. Single options are the atoms, but their real power is unlocked when they are combined to create molecules of risk known as structures. A structure is simply a position involving two or more different options or options combined with the underlying asset. It is absolutely critical to understand the distinction between a structure and a strategy. A structure is just a tool, a risk-reward profile with a specific set of Greek exposures. It is not, by itself, a strategy. A strategy requires an edge, a well-reasoned opinion on the future behavior of the underlying asset or its volatility that differs from what the market has currently priced in. The professional trading process is always sequential. Formulate a market opinion, develop a thesis on direction, volatility, skew, or timing, and then select the appropriate structure. Choose the combination of options that best expresses the specific view while adhering to risk tolerance. This section is a detailed exploration of the toolkit. We will analyze the payoff shape, the primary Greek exposures, and the market thesis for each common structure. We will also address margin requirements, as the capital required to hold a position is a critical component of the trade selection. We'll start with the long call structure. We buy a single call option. You pay a debit to open this position. It has a limited loss, limited to the premium paid, and a theoretically unlimited profit potential. The market thesis is a bullish speculation on price, combined with the view that the option's implied volatility is cheap relative to the expected magnitude of the move. It has a positive delta, increasing from near zero to 1 as the stock rises. It has a positive gamma, highest when at the money. It has negative theta, representing the daily cost of owning the option. And it has a positive vega. It benefits from an increase in implied volatility. The position is fully paid for upfront and doesn't require any margin. The only capital at risk is the premium paid. The short call structure involves selling a call option. If done without owning the underlying stock, this is a naked short call. You collect a credit upfront for opening this position. It has a limited profit, limited to the premium received, and a theoretically unlimited loss potential. The market thesis is a bearish to neutral view on price, combined with a view that implied volatility is overstated relative to our forecast of realized volatility. The trader profits if the stock falls, stays flat, or rises only modestly. It has a negative delta, becoming more negative as the stock rises, has a negative gamma, creating unfavorable risk where losses accelerate on adverse moves, has a positive theta, representing the daily income received for taking on the gamma risk, and it has a negative vega. It benefits from a decrease in implied volatility. Selling a naked call carries an immense potential risk and requires a substantial margin deposit to cover potential losses. A covered call involves combining the short call with 100 shares of stock. We will explore this later. The long put structure involves buying one put option. You pay a debit to open this position. It has a limited loss, limited to the premium paid, a large profit potential as the stock falls towards zero. The market thesis is a bearish speculation on price, combined with the view that the option's implied volatility is cheap relative to the expected magnitude of the move. It is also used as the classic hedging instrument to protect long stock from a downturn. It has a negative delta, moving from near zero all the way to -1 as the stock falls, positive gamma, negative theta, and positive vega. The position is fully paid for up front and doesn't require any margin. The only capital at risk is the premium paid. The short put structure involves selling a put option. You collect a credit upfront for opening this position. It has a limited profit, limited to the premium received, and a large potential loss as the stock falls towards zero. The market thesis is a bullish to neutral view on price, combined with a view that implied volatility is overstated relative to our forecast of realized volatility. The trader profits if the stock rises, stays flat, or falls only modestly. A cash secured put, where the seller has enough cash to buy the stock at the strike price, is a common strategy to acquire stock at a discount. It has a positive delta, a negative gamma, a positive theta, and a negative vega. Selling a naked put carries substantial risk and requires significant margin. The long straddle involves buying one call and one put with the same strike and expiration. This is usually done at the money. You pay debit to open this position. It has a V-shaped payoff. This is a pure long volatility bet used when a trader expects a massive swing but is uncertain of the direction. It starts with a delta near zero, has a large positive gamma, a large negative theta, and a large positive vega. The trader is paying a high daily rent, or theta, for explosive acceleration potential, or gamma, and sensitivity to rising fear, vega. As the price moves down away from the strike, the delta becomes more negative. We want to keep moving down. And as the price moves up away from the strike, the delta becomes more positive. We want to keep moving up. The delta is telling us the direction we would like movement to improve our P&L. That is, if it's positive, up movement is beneficial, and if it's negative, down movement is beneficial. A long straddle consists of buying two options, and that is paid for in full. There is no margin requirement. The capital at risk is limited to the premium paid. The short straddle involves selling one call and one put with the same strike and same expiration. This is usually done at the money. You collect a credit upfront for opening the position. It is an inverted V-shape, a pure short volatility bet, used when a trader expects the stock to be stagnant, profiting from the rapid decay of the two options. Again, starts with near zero delta, has a large negative gamma, large positive theta, and large negative vega. The trader is collecting a large daily rent in the form of theta as compensation for taking on the risk of explosive accelerating losses from gamma and being hurt from rising implied volatility, vega. As price moves down away from the strike, delta becomes more positive, and as price moves up away from the strike, delta becomes more negative. This is indicating our desire to stay near the strike price. A short straddle has undefined risk and requires a very large margin deposit. The long strangle is buying one out of the money call and one out of the money put with different strikes but the same expiration, typically done to keep delta near zero at inception. For example, buying one 30 delta call and one negative 30 delta put. You pay a debit to open this position. It is a wider, cheaper version of the long straddle. It is a long volatility bet that requires an even larger price move to be profitable. Directionally the same as long straddle. Near zero delta at inception, large positive gamma, negative theta, and positive vega, but with lower initial magnitudes due to the out of the money strikes. A long straddle consists of buying two options and is paid for in full and requires no margin. Capital at risk is the premium paid. The short strangle involves selling one out of the money call and one out of the money put with different strikes, but the same expiration. Again, this is typically done to keep the delta near zero at inception. For example, selling one 30 delta call and one negative 30 delta put. We collect a credit upfront for opening this position. It is a wider, higher probability version of the short straddle. It is a short volatility bet on the stock remaining within a defined range. This is a very common structure for traders systematically harvesting the variance risk premium. Directionally, it's the same as the short straddle, near zero delta at inception, negative gamma, positive theta, and negative vega, but with lower initial magnitudes because they are out of the money options. A short strangle has undefined risk and again requires a relatively large margin deposit. Debit vertical spreads, for example, example, a long call debit spread involves buying a lower strike call and selling a higher strike call. The same can be done with puts, and it looks the same, just mirrored across the y-axis. As per the name, you pay a debit to enter this position. It is a moderately bullish position for the call spread and a moderately bearish position for the put spread. It is cheaper than buying a single long option, since selling one more out of the money option helps finance the cost of the long option, but profit is capped. It's a bet that the stock will rise and on the implied volatility between the strikes. The position has a positive delta for the call spread and a negative delta for the put spread. The rest of the Greeks are dynamic and best thought of using our knowledge of the Greeks from the previous section. Near the long call strike, the short call Greeks have less influence, and we are positive gamma, positive vega, and negative theta. As we move towards the short call strike, its Greeks become more dominant, and we flip to negative gamma, negative vega, and positive theta. It is often useful to use a position designer, like the one on Oquants, and look at the instantaneous P&L versus expiration P&L to gain intuition on how the Greeks behave. Looking at this example of the call debit spread, we can see the instantaneous P&L is above the expiration P&L near the long strike. When this is the case, we are usually positive gamma, positive vega, and negative theta. Likewise, when the instantaneous P&L is below the expiration P&L, like we are closer to the short strike, our Greeks flip and we become negative gamma, negative vega, and positive theta. A credit vertical spread, like shown in the example for a short put credit spread, we sell a higher strike put and buy a lower strike put. Again, the same can be done with calls, and it looks the same, just mirrored across the y-axis. Again, as per the name, you receive a credit for opening this position. In the put case, it's a moderately bullish/neutral position that profits from rising stock, time decay, and/or a fall in volatility. The goal is for the options to expire worthless. The Greeks are dynamic and similar to debit spreads. Near the short strike, we're negative gamma, negative vega, positive theta, and near the long strike, we're positive gamma, positive vega, negative theta. The iron butterfly involves buying one put option at a lower strike, sell a put and a call at the same higher strike, and buying one more call at a third, even higher strike. This can be thought of as selling a straddle, then capping the risk with wings using a long strangle. An iron condor is a very similar structure that instead of selling the middle straddle, it sells a strangle that is more narrow than the wider long strangle used for the wings. It has a tent-shaped defined risk payoff. This is a short volatility bet that the stock price will remain within the range until expiration. It profits from a stagnant stock and time decay. The Greeks start near zero delta typically, and it has a negative gamma, positive theta, and negative vega when the stock is near the middle strike. But as before, the Greeks can flip signs if the price moves outside the wings. We can visualize this by looking at the instantaneous P&L versus the expiration P&L. When the instantaneous P&L goes above the expiration P&L, we are going to be positive gamma, negative theta, positive vega, and vice versa. While this section covers several foundational option structures, the potential combinations are nearly infinite. Any complex position, no matter how exotic, can be deconstructed into a series of long and short individual options. If you understand the Greeks and exposures of individual legs, and of the common positions above, you should be able to dissect and understand any position, no matter how complex. Ultimately, the choice of any structure should be driven by a fundamental thesis. It all comes down to your assessment of the market's pricing and whether you believe a specific option or an entire portion of the volatility surface is mispriced relative to your forecast. The structure is simply the most efficient tool you have chosen to monetize that specific view. Put-call parity is one of the most important relationships in options. For European options on the same stock with the same strike and expiration, it states that the call value minus the put value is equal to the stock price minus the present value of the strike price. We will not go into proving this here, but this relationship holds for European options and is one of the foundations of option pricing. The practical value of put-call parity is that it shows how different positions can be built to create the same economic exposure. That is the idea behind synthetics. Let's look at an example of synthetic long stock. We start with the original put-call parity formula and rearrange for the stock price. This tells us that the stock can be broken down into two parts: the options piece, the long call plus the short put, and the cash piece, which is the present value of the strike price. The long call plus the short put portion is what gives you the stock-like exposure. If the stock rises, the position gains. If the stock falls, the position loses. That is why traders often call it synthetic long stock. So what is the cash component doing? The cash component is the financing leg. It is the amount of cash that if invested today at the current interest rate, will grow into the strike price K by expiration. That is what makes the relationship exact and arbitrage free. This also helps explain what you see on an options graph. If you look only at a long call and a short put of the same strike, the instantaneous P&L often appears above the expiration P&L before expiration. That is because the parity relationship assumes you also hold the present value of the strike price K cash amount alongside the options position. In other words, the graph is effectively assuming there is a financing balance earning interest in the background. The cash grows over time and offsets what would otherwise look like decay. So the intuition is call minus put gives you the stock-like payoff exposure, and the present value of the strike price is the financing adjustment that keeps the pricing exact today. At expiration, that financing term has grown into K. So the instantaneous P&L of the synthetic lines up with that of stock. In practice, when traders say synthetic long stock, they are usually focused on the fact that long call plus short put replicates the stock's directional payoff, while the cash component explains the pricing difference before expiration. Put call parity also explains why call spreads and put spreads are really just different ways of building the same trade. For example, we can build a debit vertical call spread by buying the 100 strike call and selling the 110 strike call. We can build a credit put vertical spread by selling the 110 strike put and buying the 100 strike put. These have the same basic payoff at expiration. One is entered for a debit and the other for a credit. But economically, they are just two ways to express the same bullish, defined risk idea. That matters because a trader can choose the version with better liquidity, tighter bid-ask spreads, and better margin treatment. Put call parity also shows the relationship between a covered call and a cash secured short put. A covered call is long 100 shares and short one call, and a cash secured put is short one put and cash set aside to buy the shares if assigned. These positions have the same payoff profile when the strike and expiration are the same. That means if someone says, I would never sell a put because it is too risky, but they are happy to sell covered calls, they may not realize they are taking on almost the exact same risk exposures. This is the real power of put call parity. It helps you look past the label of a strategy and understand the actual risk underneath. While the Greeks provide a sophisticated dashboard for managing the known sensitivities of an option position, a trader must also be acutely aware of a set of risks that are event-driven, structural, or arise from the very mechanics of the options market. These risks often materialize at critical moments, near expiration, or during periods of market stress, and can lead to unexpected losses if not properly understood and managed. Pin risk is the extreme uncertainty a trader faces when the underlying asset's price is trading almost exactly at an option's strike price at the moment near expiration. This risk primarily affects sellers of options. In a perfectly rational world, an option will be exercised if it is in the money by even 1 cent, and will be left to expire worthless if it is at the money or out of the money. However, the final moments of trading on an expiration day are chaotic. The stock's closing price can fluctuate considerably, and the final settlement price may not be known with certainty. This creates a dilemma for the option holder. For an option seller, this is a nightmare. You have no way of knowing for certain whether you will be assigned a stock position. You go home on Friday with what you thought was a worthless option position, only to arrive on Monday morning to find you're unexpectedly long or short 100 shares per contract. This unplanned position exposes you to the full risk of any adverse price movement over the weekend. The only professional way to handle pin risk is to eliminate it. Systematically close any short option positions that are trading near their strike price in the final hours before the close on expiration day. The small profit you might give up by closing the trade is negligible compared to the cost of managing an unexpected weekend stock position. You can also trade cash settled options. Index options like those on the SPX are cash settled and not subject to this specific type of pin risk, as there is no stock to be delivered. Early exercise risk is the risk to an option seller that the buyer will exercise their American style option before the expiration date. This is not a random event. While suboptimal early exercise can occur due to a novice trading error, there are two specific rational scenarios where exercising early is the financially optimal decision for the holder. Sellers of American-style options must be constantly aware of these conditions. Let's look at scenario 1 with the optimal early exercise of a deep in-the-money put. A holder of a deep in-the-money American put may choose to exercise early to capture the time value of money on the strike price. The logic is this: when you exercise a put, you sell your shares and receive cash equal to the strike price times the multiplier. The earlier you get that cash, the earlier you can invest it at the risk-free interest rate. For a deep in-the-money put, the remaining extrinsic value or time value is often very small. If the interest you could earn on the cash between now and expiration is greater than the tiny amount of extrinsic value you would forfeit by exercising, then early exercise is the optimal choice. Let's look at an example. Imagine you hold a put option on stock XYZ with a $200 strike, and the stock is currently trading at $150. The put is deep in the money with $50 of intrinsic value. Let's say the option's current price on the market is $50.10, meaning it has only 10 cents of extrinsic value left. If you can earn more than 10 cents in interest by receiving the $20,000 in cash today instead of at expiration, you should exercise the put. The option seller is then forced to buy 100 shares of XYZ at $200, creating an unexpected long stock position. Let's take a look at scenario 2 with optimal early exercise of a deep in the money call for dividend capture. A holder of a deep in the money American call may exercise early, specifically to capture an upcoming dividend payment. The logic is this: an option holder does not receive dividends paid by the underlying company. To receive the dividend, you must own the stock on or before the ex-dividend date. For a deep in the money call, the remaining extrinsic value is often very small. If the upcoming dividend payment per share is greater than the intrinsic value per share of the call option, the holder will exercise the call the day before the stock goes ex-dividend. This allows them to buy the stock at the strike price and collect the dividend, which more than compensates for the small amount of extrinsic value they forfeit. Let's look at an example. You hold a call option on stock ABC with a $90 strike, and the stock is currently trading at $120. The call has $30 of intrinsic value. Let's say on the open market, the option is currently going for $30.25, meaning it has only 25 cents of extrinsic value. The company announces it will pay a $1 dividend tomorrow. By exercising the call today, you get to buy the stock for $90 and you will receive the $1 dividend tomorrow. You give up 25 cents of extrinsic value, but gain $1 in cash. The call seller is then assigned, being forced to sell their shares or establish a short position at $90 right before the dividend is paid. Liquidity risk is the risk that you cannot enter and, more importantly, exit a position at a fair, competitive price due to lack of market participants for that specific option. The problem is this: the price you see quoted for an option on your screen might be an illusion. You must always look at the bid-ask spread. A wide spread, for example a bid at $2.10 and an ask at $3.80, is the hallmark of an illiquid option. Crossing this spread to enter or exit a trade is an immediate and substantial cost. More importantly, if you are forced to exit as a result of a margin call or other factors, you may have to sell at bid or buy at ask, crossing the spread and realizing a substantial loss. In times of market stress, liquidity can evaporate completely. Market makers may pull their quotes, and you may find it extremely difficult to close a position or adjust a hedge at any reasonable price. You can be trapped in a losing position, forced to either liquidate at a terrible price or ride it out and hope for the best. Always check an option's volume, how many contracts traded today, and more importantly, its open interest, the total number of outstanding contracts. High open interest indicates a deep and liquid market where you can trade efficiently. Avoid options with very low open interest unless you intend to hold them to expiration and are comfortable with the associated risks. Gap risk is the risk that an underlying asset's price will change dramatically and discontinuously, moving from one price to another with no trading in between. This often happens overnight or in response to major news like earnings, clinical trial results, or geopolitical events. This risk is the Achilles heel of any strategy that relies on delta hedging, something we will cover later. The BSM model and the Greeks assume that prices move continuously, allowing for a hedge to be constantly adjusted. A price gap makes this assumption false. If you are short gamma, for example short a straddle, you are betting on low volatility. A large gap move means your losses accelerate instantly. Your delta hedge, which was correct at Friday's close, is catastrophically wrong at Monday's open. You cannot adjust your hedge during the gap, so you are forced to realize a large, unhedgeable loss. This is one of the primary ways that option sellers can face catastrophic losses. Position sizing. The most crucial defense is to keep short gamma positions small enough that a worst-case gap move does not result in a ruinous loss. We know that gaps are a possibility, and a trader blowing up or going out of business for something they know can happen is the opposite of professional trading and more akin to gambling. Own the risk instead of trying to continuously hedge it. For example, instead of selling a naked strangle, a trader might sell an iron condor. Buying the far out of the money wings provides a defined, worst-case loss scenario that protects against an extreme gap move. Borrow cost risk. When traders hedge positions, they often need to short the underlying stock. The ability to do this depends on the availability of shares to borrow. If a stock becomes hard to borrow, the fee charged to short can dramatically spike. In extreme cases, a stock can go on mandatory recall, meaning you are forced to buy it back in the open market. This can wreak havoc on hedge positions. To mitigate this, avoid hard-to-borrow names. Before putting on strategies that may require short stock hedging, check whether the stock is easy to borrow and what the current borrow fee is. A trade that looks attractive on paper can become poor very quickly once borrow costs are included. We must continuously monitor borrow cost conditions. Borrow availability and fees can change quickly, especially in crowded shorts, meme stocks, or low float names. A stock that is easy to borrow today may become expensive or unavailable tomorrow. If it becomes hard to borrow, consider closing the trade if the hedging cost of the shares eats into the trade's expected edge. We can also prefer defined risk structures. If borrow availability is uncertain, use option structures that do not require active short stock hedging. Defined risk positions reduce the chance that a borrow problem turns into a portfolio problem. Now that you understand the contract itself, the pricing framework, and the Greeks, we can move to the single most important concept in professional options trading: volatility. This is where most retail option education completely falls apart. Because if you trade options without understanding volatility, you are not really trading options. You are just making leveraged directional bets without understanding what you actually own. In this section, we're going to fix that. We'll break down implied versus realized volatility, how professionals measure volatility, why volatility tends to be priced the way it is, and how skew and term structure reveal what the market is actually charging for risk. Once you understand this section, you stop looking at options as a simple bullish or bearish bet and start seeing them as priced volatility instruments. In section 1, we established that volatility is the most critical yet most nuanced driver of an option's price. We stated that when you trade options, you are fundamentally trading volatility. Now we will dissect this concept, moving from intuition to a rigorous quantitative understanding. This section is the heart of professional options trading. Mastering this is what separates those who gamble on direction from those who trade volatility as an asset class in itself. Before we can compare different types of volatility, we must understand its relationship with time. This is one of the most foundational principles in quantitative finance, and it directly impacts every option's price. The key takeaway is this: volatility does not scale linearly with time. It scales with the square root of time. This concept is a direct consequence of the random walk assumption that underpins the BSM model. The model assumes that stock returns are independent from one day to the next. Think of it like a drunkard's walk. Imagine a drunkard leaving a bar. Each step he takes is random. After one step, he is 1 unit away from the door. After 4 steps, is he 4 units away? Unlikely, because his steps are random. Some will be to the right and some will be to the left. Many of the steps will cancel each other out. The statistical expectation is that his distance from the door will be proportional to the square root of the number of steps he has taken. After 4 steps, he is expected to be the square root of 4, or 2 units away. After 100 steps, he is expected to be the square root of 100, or 10 units away. Stock prices behave similarly. The variance, or the square of volatility, of returns is assumed to be additive over time. If we assume the variance of 1 day's return is sigma squared, then the variance over t days is t times sigma squared. To get back to volatility, or the standard deviation, we must take the square root of the total variance. This gives the volatility over t days as being equal to the square root of t times sigma squared, or sigma times root t. This mathematical relationship is the reason why an option with 60 days to expiration is not twice as expensive as an option with 30 days to expiration. All else being equal, its price will be related by a factor of square root 2, or about 1.41. This square root t factor is embedded in the BSM formula, and it is the precise link that connects an option's Vega with its theta. When you grasp this concept, you begin to see time and volatility not as separate forces, but as two sides of the same coin, the total uncertainty of an asset's future path. The word volatility is often used as a single catch-all term, but a professional trader must be extremely precise. We are always concerned with 2 distinct types of volatility: the volatility that has happened and the volatility that is expected to happen. Realized volatility is a factual, statistical measure of how much a stock's price has fluctuated in the past. It is a historical fact calculated from prior price data. It is not actually exact and has to be estimated, but we will see this soon. It looks backwards in time. Let's look at this analogy. RV is the trip computer in your car. After the journey, it can tell you with certainty that your average speed over the last 100 miles was 65 miles per hour. It is a report of what has already occurred. Implied volatility is the market's collective forecast of how much a stock's price will fluctuate in the future over the life of an option. It is not directly observable. It is the one unknown variable in an option pricing model that is implied by the option's current market price. As an analogy, IV is looking at the road ahead. You see heavy traffic, dark storm clouds, and know it's rush hour. Based on this information, you forecast that your average speed for the next 100 miles will likely be 40 miles per hour. This forecast is a consensus opinion formed by every driver on the road, and it determines the price of the journey in terms of time. The core of professional options trading lies in the dynamic interplay between these two forces. You use the past, or RV, as one of your primary tools to judge whether the forecaster, IV, is being overly optimistic or pessimistic. It is a common misconception among novice traders that a pricing model like BSM is used to find out what an option should be worth. The reality is the exact opposite. In a liquid market, the market itself decides the option's price through raw forces of supply and demand. Professionals use the BSM model as a translator. We take the known, complex price of the option and run the model in reverse to solve for the one missing variable, volatility. The result is the implied volatility. This is its most powerful function. It acts as a universal price tag for uncertainty. It allows us to take the noisy, complex world of option premiums, a $3 option on a $50 stock, a $15 option on a $400 stock, one expiring in 1 week, one expiring in a year, and standardize them into a single comparable number. It lets a trader say, this market is currently pricing in a 25% annualized level of uncertainty for both these stocks. This provides the language needed to compare value across assets and across time. When IV is high, the market is pricing in a high degree of future movement, and option premiums are expensive. When IV is low, the market is expecting a quiet period, and premiums are cheap. If we compare the market's forecast, IV, to what actually happened, subsequent realized volatility or RV, we find the single most important and persistent phenomenon in the options market. On average, and over time, implied volatility tends to be higher than realized volatility. This systematic overpricing of options is known as the variance risk premium, or VRP. So why does this exist? The answer lies in human nature and risk aversion. Think of the options market as a massive insurance market. There is a constant structural demand for options, particularly out-of-the-money puts. Large institutions, pension funds, and portfolio managers are perpetually worried about market crashes. They buy puts to insure their portfolios against catastrophic losses. Like a homeowner buying fire insurance, they are willing to pay a premium that is statistically too high for the peace of mind and protection it provides. On the other side of the trade are the sellers of these options, the insurance companies of the market. These traders, from large market-making firms to individual volatility sellers, are accepting the risk of potentially massive or even unlimited losses to be coaxed into taking on this dangerous tail risk. They demand to be paid a significant premium over the fair statistical price. This imbalance, persistent, price-insensitive demand for insurance, met by risk-averse suppliers, creates a structural inflation in options prices. The VRP is the compensation that sellers of volatility demand for taking on the risk that others are desperate to offload. Understanding that this premium exists is the foundation of countless professional strategies. The goal of a theta decay strategy is not merely to collect theta, it is to systematically harvest the VRP. It is important to remember that the VRP is a generality, and it is not present on all stocks and not available at all times. We will dive much deeper into the nuances of how to trade this effect later in the course. If our goal is to determine whether the market's forecast of IV is fair, we first need a reliable benchmark. This benchmark is our best possible estimate of historical realized volatility. Measuring it accurately is a science in itself. When calculating volatility, we don't use the simple percentage change of a stock price that you might see on the news. Professionals exclusively use logarithmic returns, calculated as the natural logarithm of today's price divided by yesterday's price. While the day-to-day difference between simple and log returns is often tiny, the mathematical properties of log returns are vastly superior and absolutely essential for building correct financial models. Let's break down why. This is the most important practical reason for using log returns. Log returns are additive over time. This means to get the total return over a week, you simply add up the 5 daily log returns. This property does not hold for simple percentage returns, where you must deal with the messy process of compounding. Let's illustrate with a clear example. A stock starts at $100. Over the next 3 days, it has the following simple percentage returns: plus 10%, minus 5%, and plus 8%. calculating final price the hard way. To find the final price using simple returns, we must compound them. We then take the end of day 1 price multiplied by the day 2 return to get the end of day 2 price. And finally, we take the end of day 2 price multiplied by the day 3 return to get the end of day 3 price. The total simple return is not 10% minus 5% plus 8% or 13% total. The true total return is 12.86%. To work with simple returns over time, you always have to chain these multiplications together, which is very cumbersome for modeling. Now let's use log returns, or the easy way. First, we convert each day's price into a log return. This is simply done in the way we described previously, by taking the natural logarithm of today's price divided by the previous price. To find the total log return for the entire 3-day period, we simply sum them up. This gives us a total log return of 0.121. And then to convert this total log return back to the final price, we use the exponential function e to the power of x, and we can get the final price by taking the starting price multiplied by e to the power of the total log return for a final price of $112.86. The result is identical. This property of additivity is a superpower for quantitative analysis. It allows us to model multi-period returns by simply summing up single-period returns, a process that is mathematically clean and computationally efficient. A key requirement for most statistical models is that data is stationary, meaning its statistical properties, like its mean and variance, don't change over time. Raw prices are not stationary. A stock's price trend makes it non-stationary. Furthermore, a $1 move means something very different for a $10 stock, a 10% move, than for a $500 stock, a 0.2% move. You cannot meaningfully compare the volatility of a stock when it was $10 to when it was $500 using its raw price changes. Log returns are more stationary because log returns are effectively unitless percentage changes. They create a time series that is much more stable and comparable over time. This allows us to build models that are valid across different price levels and long historical periods. It is a fundamental and critical concept to internalize that we can never know the true volatility of a stock. We can only estimate it from the discrete price data we observe. Think of a stock's price movements as being generated by a complex underlying random process generator. This machine has a true intrinsic volatility setting, its true volatility. However, we never get to look inside the machine or read its settings. All we get to see is the output, a series of daily prices. Our job is to look at this limited output and reverse engineer our best possible guess of what the machine's internal volatility setting is. This best guess is our realized volatility calculation. Because it's an estimate based on a limited sample of data, it is subject to statistical error, and the choice we make about which data to use can drastically change the result. This is where the art of data selection comes into play. The most immediate choice a trader must make is the look-back period, or how much historical data to include in the estimate. This choice presents a classic trade-off between statistical robustness and market relevance. For instance, with a long look-back, like 180 days or 252 days, we have more data, but older information. A long look-back period provides a large sample size, which is statistically desirable, because it reduces the impact of any single day's noise and gives a more stable estimate. However, its greatest weakness is that it may be contaminated by old, irrelevant market regimes. For example, imagine it is early 2022. The Federal Reserve has just pivoted from a transitory inflation stance to an aggressive rate hiking cycle. If you calculate the 252-day RV, your estimate will include months of data from 2021, a period characterized by zero interest rates and a completely different market environment. That low volatility from that old regime will pollute your calculation, causing your RV estimate to be artificially low and not reflective of the new, higher volatility reality. You have a statistically stable number that is telling you the wrong story about the current market. With a short look back, for example 20 or 30 days, it's more relevant, but it has higher noise. A short look back is far more sensitive to the current market environment, which is what we often care about the most. It quickly adapts to new conditions. However, its small sample size makes it highly susceptible to being dramatically skewed by 1 or 2 outlier days. For example, consider a stable, low volatility stock that has been moving less than 0.5% a day. You are calculating the 20-day RV. On one of those days, a surprise announcement causes the stock to gap down 15%. This single data point will have an enormous impact on the calculation. The resulting 20-day RV will be extremely high, suggesting that the stock is massively volatile. But is it? Or was it just a calm stock that just experienced a one-off shock? A short look-back period can mistake single event for new persistent state of high volatility. This leads directly to the problem of how to handle massive, one-off events that are not representative of a stock's normal day-to-day behavior. If you are calculating 30-day RV for a biotech stock, and one of those days included a 40% price collapse on a failed clinical trial, what do? There is no single correct answer, and this is where quant firms apply their proprietary rules. The decision reflects a fundamental choice about what you are trying to measure. The argument for including the event is that the event happened. It is a real part of the stock's return distribution. Ignoring it is to ignore the reality of tail risk. The fact that the stock can drop 40% in a day is a critical piece of information, and removing it from your model might cause you to underestimate the true risk you are taking when you're selling its options. The argument for excluding or capping the event is the goal of your RV estimate might be to understand the stock's typical daily volatility in the absence of a binary news-driven event. Including the 40% drop will pollute the estimate for the next 30 days, making the stock seem far more volatile on a normal day than it actually is. In this case, a firm might apply a rule to cap any single day's return at, for example, 4 or 5 standard deviations, or to remove it entirely from the calculation. This provides a more stable estimate of normal day-to-day volatility, but knowingly sacrifices some information about extreme tail events. Ultimately, understanding that RV is an estimate frees you from the trap of believing that there is one correct number. Instead, a professional trader often looks at RV calculated across multiple lookbacks, for example, the 10-day, 30-day, and 90-day, and with different event handling rules to build a more nuanced and complete picture of a stock's historical behavior. The goal of different estimators is to extract the most information about volatility from the price data available. They range from simple to complex. They are usually measured by efficiency, meaning how fast the estimator converges to the true underlying volatility. That means if estimator A converges within 5% error of true volatility using 10 days of data, but estimator B converges within 5% error of true volatility using 30 days of data, it can be said that estimator A is more efficient than estimator B. The close-to-close estimator. This is the simplest estimator, calculated as the standard deviation of daily log returns using only closing prices. Its primary flaw is that it is incredibly inefficient. It ignores all the information contained in the stock's price movements during the trading day, and crucially, any overnight gaps. The Parkinson estimator. This estimator uses the daily high and low prices. It is more efficient than the close-to-close because a wider daily range implies higher volatility. Its flaw is that it ignores overnight gaps and is sensitive to outlier high or low prices since it ignores open and close. The Garmin-Class estimator. This estimator uses open, high, low, and close prices. It is a major improvement because it incorporates the information from the intraday range. It is a widely respected industry standard. Its primary flaw is that it still ignores overnight gaps. The Yang-Zhang estimator. This is generally considered the most statistically efficient and robust estimator. It combines multiple components, including the overnight gap, the open to close volatility, and the intraday range, to produce an estimate with high efficiency. We generated stock data with a true annualized volatility of 20% to measure how efficient each of these estimators are. We can see that the range-based estimators do a significantly better job at correctly measuring the true volatility of the underlying process when compared to the naive close-to-close estimator. We can also see that all range-based estimators perform relatively similarly in terms of efficiency. That being said, the underlying process used to generate the data is geometric Brownian motion, which assumes a normal distribution with no additional jump volatility. As we'll see later, this assumption is not true in real markets, and with real market data where returns are not perfectly normal. And when there are discontinuous large jumps, which is true for most underlying assets, the Yang-Zhang estimator will be more efficient than the other range-based estimators. The key point is this: while Yang-Zhang may be academically superior, since it incorporates overnight gaps and is the most efficient estimator mentioned, the choice of estimator is less critical than understanding its properties and applying it consistently. For any serious trader, using Garmin-Class or a similar range-based estimator is a significant and necessary step up from the naive close-to-close method. When in doubt, defaulting to Yang-Zhang is a great choice. To compare volatility across different timeframes and assets, we must standardize it. The market convention is to quote all volatility in annualized terms. Anytime you see a quoted implied volatility number, it is almost always the annualized volatility figure. The formula stems directly from the root time rule. The annual volatility is equal to the volatility period times the square root of the number of periods in a year. For example, to go from a daily volatility measure to an annualized measure, we multiply by the square root of 252. where 252 is the number of trading days in a year. To go from a weekly volatility measure, we take the weekly measure times the square root of 52, or the number of weeks in a year. A fantastic and essential shortcut for translating an annualized volatility number into a practical daily expectation is the rule of 16. The rule of 16 stems from the fact that the square root of 252 is approximately 15.87. So we can go from an annualized measure into an expected daily move. To do this, we take the annualized volatility figure and divide by 16, or more precisely, divide by the square root of 252. For example, a stock has an implied volatility of 32%. What is the market pricing in for a daily move? Well, we can take 32 and divide it by 16 to get 2%. This means the option market is pricing a normal daily move to be within plus or minus 2%. If you see an IV at 80%, you instantly know the market is bracing for 5% daily swings, or 80 divided by 16. This mental math is invaluable for quickly judging whether a premium feels cheap or expensive. Having a good RV estimate is crucial, but it is not a source of trading edge in itself. Institutions have teams of PhDs and immense computing power dedicated to building the perfect volatility estimators. You will not outmodel them. The entire purpose of carefully measuring RV is to establish a reasonable, objective benchmark of historical fact. This benchmark becomes your fair value estimate, against which you can compare the market's subjective forecast IV. You do not get paid for knowing what volatility was. You get paid for having a more accurate assessment of future volatility than the market's current price, or implied volatility. This is the origin of all volatility-based trading edges. However, a professional's approach to forecasting is often misunderstood. It is not about gazing into a crystal ball to predict that realized volatility over the next 30 days will be exactly 21.7%. This kind of pinpoint prediction is impossible. Instead, the goal is to build a robust, evidence-based case to determine if the current price of volatility, IV, is fair, cheap, or expensive. The process is less about predicting a specific number and more about valuing the current price. We do this by blending historical data with current market context to form a directional opinion on volatility. That is the future realized volatility going to be less or more than what is currently being priced in by the market's implied volatility? We only need to tilt the odds in our favor to acquire a trading edge. The core of this process is to ask, is today's price of volatility justified? We can answer this by looking at the market from two primary angles. The first is absolute valuation. Is implied volatility cheap or expensive relative to itself? This involves comparing the current implied volatility to its own historical behavior. We are looking for extremes that may indicate an over or under pricing of risk. We can look at the IV percentile. Where does the current IV of 35% rank over the last year? If it's in its 90th percentile, it is historically very high. If it's in its 10th percentile, it is historically very low. We can look at IV versus recent RV. How does the current implied volatility compare to the volatility that the stock has actually realized over the last 10, 30, or 90 days? Is the market paying a massive premium over recent history, or is it underpricing it? We can look at skew steepness. Is the smirk unusually steep or flat compared to its historical norms? A very steep skew might suggest that puts are exceptionally expensive relative to calls, or vice versa. Then we can do a relative valuation. Is IV cheap or expensive relative to its peers? No asset exists in a vacuum. We can find valuable clues by comparing an asset's volatility to that of closely related assets. Mispricings often appear as dislocations in these relationships. Versus sector or index. Is the IV of a specific tech stock trading unusually high or low compared to the IV of the NASDAQ? We can look versus competitors. Are two competing companies, which normally have very similar volatility profiles, currently showing a wide divergence in their IV levels? We can look at cross-asset. For a macro view, how does equity volatility, or the VIX, look compared to credit market volatility, the MOVE index, or currency volatility? By combining these absolute and relative valuation techniques, we can form a well-reasoned, defensible thesis. For example, given that XYZ's IV is at its 95th percentile and is trading 15 points above its main competitor, a historical extreme, the current price of its volatility appears expensive. This conclusion, that IV is overpriced, is the forecast. The trade is then structured to profit if this view is correct. That is, if future RV is lower than the current expensive IV. Finally, this valuation is not a one-time event. It is a living hypothesis that must be constantly reevaluated as new information arrives. A change in the market environment, A surprising earnings report from a competitor or a shift in the macro landscape can change the fair value of volatility. A successful trader is constantly absorbing new data and updating their view, ready to adapt as their edge waxes and wanes. This day zero mentality drives the adjustments we will make to the trades, whether that means closing trades early for gain or for loss, or leaning harder and sizing up if it becomes more mispriced. To effectively trade volatility, you must understand its personality. Volatility isn't just a random number. It exhibits consistent, observable behaviors across almost all financial markets. These stylized facts are the fundamental laws of physics that govern volatility's movements. Internalizing them allows you to build a reliable intuition for what is normal, and more importantly, to spot when market behavior is deviating from the norm. The most basic, yet often confused fact is that volatility is directionless. It is a measure of the magnitude of price swings, not their direction. A stock can have identical volatility in 3 completely different scenarios. For example, one can trend clearly up, one can trend clearly down, and one can bounce back and forth and not go anywhere. The path and end results are different, but the magnitude of the daily fluctuations, the volatility, is exactly the same. High volatility simply means the price is covering a lot of ground. This can happen in a roaring bull market, a crashing bear market, or a violent, choppy sideways market. Never mistake high volatility for the market is going down. While the volatility number itself is directionless, in equity markets, it has a famous and critically important relationship with the direction of returns. That is, the correlation between spot price changes and volatility, or spot vol core. For equities and indices, when the stock market spot price falls, volatility tends to rise sharply. When the market rises, volatility tends to fall or remain muted. This inverse relationship is the most dominant stylized fact in most equity options. The VIX index, often called the fear gauge, is the classic example. When the S&P 500 falls, the VIX spikes. When the S&P 500 rallies, the VIX tends to drift lower. Why does this happen? The primary theory is the leverage effect. As a company's stock price falls, its total value decreases, but its debt remains the same. This increases the company's debt to equity ratio, making the company financially riskier. This increased risk in the business translates directly to higher volatility in its stock price. A secondary reason is the simple fear response. Panic selling during crashes causes wild price swings, driving up volatility. This negative correlation is the fundamental economic reason for the volatility skew, which we will discuss next. It justifies why options that pay off in a crash are systematically more expensive than options that pay off in a rally. For other assets, this relationship is not universal. In other assets, the correlation can be different. For example, for gold, it often has a near zero spot vol correlation. It is seen as a safe haven, and its volatility can rise in both up and down markets. For oil and commodities, the correlation can be positive. Rising oil prices are often accompanied by geopolitical tension and supply uncertainty, leading to higher volatility. Knowing your underlying's typical spot vol correlation is essential. Applying an equity mindset to a commodity option can lead to costly mistakes. Volatility itself is volatile. The measure of this is often called vol of vol. When the general level of market volatility is high, its day-to-day fluctuations are also larger. For example, the CBOE VVIX index measures the implied volatility of the VIX itself. When the VIX is trading at a high level, for example 40, the VVIX will also be relatively high, indicating that traders expect the VIX to have massive daily swings. When the VIX is low, for example 12, the VVIX will also be much lower, as the VIX itself is expected to be relatively stable. This means that when you are in a high volatility environment, the risk is not just that the market will move a lot, but that your measure of risk will also be incredibly unstable. Volatility is autocorrelated. This is a statistical term, meaning the level of volatility today is a good predictor of the level of volatility tomorrow. In practice, this leads to volatility clustering. If you look at any historical price chart, you will not see random spikes in volatility scattered evenly through time. Instead, you will see distinct periods or clusters of high volatility followed by periods of calm. A market shock will usher in a period of choppy, high variance trading that can persist for days or weeks before it subsides back into a low volatility regime. For a trader, it means your best estimate of volatility tomorrow is the volatility today. While volatility clusters in the short term, over the long term, it exhibits strong mean reverting behavior. it tends to eventually return to a long-term average. Extremely high levels of volatility are not sustainable. They reflect acute fear or uncertainty, which eventually resolves. After a market crash and a VIX spike to 50, the VIX will not stay at 50 forever. Over time, it will inevitably drift back down towards its long-term historical average. Conversely, extremely low levels of volatility are also not permanent. They reflect complacency and an underpricing of risk. A VIX below 10 is a sign of an unusually calm environment that is unlikely to last. Sooner or later, an unexpected event will occur, causing volatility to spike back up towards its mean. This mean reverting property is the basis for many professional relative value volatility strategies. This is where theory collides with reality. If the BSM model were perfectly correct, its assumptions of a single, constant volatility would mean that every option on a given stock, regardless of its strike price or expiration date, would have the exact same implied volatility. The plot of IV would be a perfectly flat line. This is not what we see in the real world. The reality is a complex, three-dimensional surface with hills, valleys, and slopes. This is the volatility surface. It is a 3D plot of implied volatility across strike prices on the x-axis and timed expiration on the z-axis. Understanding the shape of this surface is paramount because the surface is the market. Its shape reveals the true price of risk for different outcomes and time horizons. The volatility surface can be broken down into two components: the skew, or how implied volatilities change across strikes in the same expiration, and the term structure, how the implied volatilities change across different expirations. It is crucial to remember that implied volatility itself is constantly changing based on supply and demand. The shape of the implied volatility surface, skew, and term structure are also consistently changing. The volatility surface exists because the BSM model's assumptions are flawed, but it is a mistake to think the surface is only a result of these flaws, like the log normal distribution of returns. The primary driver of the surface's shape is supply and demand. The price of a specific option is determined by how many people want to buy it versus how many are willing to sell it. The surface reflects the collective risk appetite of the entire market. It is the market's fair price for future scenarios. If we take a two-dimensional slice of the volatility surface for a single expiration date, we get the volatility skew. It shows how implied volatility changes as we move from low strike out of the money puts to high strike out of the money calls. For equities and their indices, this plot is almost never a symmetrical smile. It is a downward sloping smirk, where the implied volatility of out-of-the-money puts is significantly higher than the implied volatility of at-the-money options, which is in turn generally higher than the implied volatility of out-of-the-money calls. The shape of the skew tells us how the options market is pricing the chances of different outcomes by expiration. In other words, it gives us a window into the market's implied view of future returns. If volatility were flat across strikes, as in the simplest option models, that would suggest a smooth, fairly balanced distribution of returns around the expected move. Large upside and downside moves would be treated more evenly, and extreme outcomes would look relatively rare. But that is not what we see in equities. The equity smirk suggests a distribution with two important features. The first is negative skewness, or the longer and tilted left tail. The fact that out-of-the-money puts trade at much higher implied volatilities than at-the-money options shows that the market is placing extra weight on sharp downside moves. In plain English, traders are willing to pay more for crash protection than for similar upside exposure. That means the implied distribution is not balanced. It has a skewed left tail. The second is leptokurtosis, or fat tails. The smirk also tells us the market expects extreme moves to happen more often than a simple normal bell curve style model would imply. The distribution is not only tilted to the downside, but also has fatter tails overall. That means both crashes and outsized rallies are more possible than a standard normal distribution would suggest. Options are not priced as if the world is smooth, symmetric, and calm. They are priced as if large downside shocks are a real risk and as if extreme moves happen more often than a simple normal distribution would assume. The smirk shape is not an accident. It is carved by powerful supply and demand forces, creating distinct risk premia on both sides of the distribution. There is the downside skew premium, which is associated with fear. As we've covered, there is a structural, persistent demand from institutions to buy out-of-the-money puts as portfolio insurance. To be coaxed into selling this protection against a market crash, option sellers demand a significant premium. This premium is not just the probability of a crash, but for the convexity of that risk, the fact that losses accelerate catastrophically in a downturn. This is the primary driver of the smirk's steep slope. On some stocks, there is also the upside skew premium, which can be associated with greed. Fear isn't the only emotion at play. The right tail of the skew, the out of the money calls, has its own unique supply and demand story. There is consistent demand from speculators who treat deep out of the money calls as lottery tickets. They are willing to overpay for a small chance at an enormous uncapped payoff. Just as a seller demands a premium for taking on crash risk, they may also demand a premium to sell a lottery ticket that could expose them to unlimited losses in a massive rally. This demand for lottery tickets and the premium sellers charge for it is what causes the far right tail of the smirk to flatten out or even tick up significantly in some cases. A common mistake is thinking skew only matters when you are explicitly trying to trade skew. In reality, anytime your position uses options at more than one strike, skew can matter. The moment you buy one strike and sell another, you are no longer just trading volatility. A component of the trade becomes the relationship between volatilities between the strikes. This does not mean every spread is purely a skew trade. Delta, other Greeks, and the stock's move still matter a lot, and a lot of the times, significantly more than any skew considerations. But it does mean skew affects your entry price, your risk, and often your edge. The key takeaway is simple. If your strategy uses more than one strike, skew is a part of the trade. You may not be placing a clean, isolated skew bet, but skew still affects what you pay, what you collect, and how the position behaves as the market moves. If we take a different slice of the volatility surface, looking only at the money options across all available expiration dates, we get the volatility term structure. It is the market's consensus view on how uncertainty is distributed over time. Its shape is one of the most powerful indicators of market sentiment. A contango term structure is the normal state of affairs. Under normal market conditions, the term structure is upward sloping. This state is known as contango. This means long-term IV is greater than short-term IV. This is a logical and intuitive state. There is simply more uncertainty about the world in 1 year than there is about tomorrow. Over a long time horizon, there are more potential economic reports, geopolitical events, and company-specific news that could occur. The market demands a higher premium to ensure against the greater number of unknown unknowns further out in the future. Then there's backwardation, the signal of acute fear. Occasionally, the term structure will invert, with near-term options becoming more expensive than long-term options. This state, backwardation, where short-term IV is greater than long-term IV, is a powerful and unambiguous signal of acute market stress. Backwardation happens for two reasons. The market is panicking about something happening right now. A financial crisis, a flash crash, or a pandemic onset will cause a massive rush for immediate protection, driving the price of front-month options higher. And also known event risk. A major binary event is on the horizon. The most common example is a company's earnings report. The IV of the weekly option that expires right after the announcement will be massively elevated to account for the huge potential price gap, while options expiring months later will be less affected. Backwardation is an inherently unstable state. Panic eventually subsides and events pass. As a result, backwardated term structures usually revert back to contango, often accompanied by a sharp drop in overall volatility levels. The shape of the term structure allows us to calculate the market's implied price for volatility in a specific future period. This is known as forward volatility. For example, if we know the market's price for 30-day implied volatility, let's call it IV1, and 60-day volatility, let's call it IV2, we can derive the market's price for the 30-day period that starts 30 days from now. The formula for forward volatility is the square root of the further term IV squared times the time to expiration of the further expiration minus the near-term expiration implied volatility squared times the time to expiration of the near-term expiry divided by the far-term time to expiry minus the near-term time to expiry. Again, IV1 is the implied volatility of the near term, IV2 is the implied volatility of the further term, T1 is the time to expiry in years of the near term, and T2 is the time to expiry in years of the further term. In this example, the 30-day expiration is pricing in 22% implied volatility, and the 60-day expiration is pricing in 28% volatility. Since variance adds over time, we can back out the market's implied volatility specifically for the 30 to 60-day period. You can think of the 60-day expiration as being made up of two pieces. The first 30 days, which we already know from the 30-day option, and the next 30 days, which is the forward period we're solving for. Once we isolate that forward variance and take the square root, we get the forward volatility. In this example, the 30 to 60-day forward volatility is about 32.9%. This isn't just a theoretical curiosity. It's a tradable market. If you think the market is underpricing the potential for volatility 2 months from now, you can structure a trade to buy that specific forward period. The main strategy used to trade the term structure is the calendar spread. A calendar spread uses the same strike and same option type, but with different expirations. A standard long calendar is built by selling the shorter dated option and buying the longer dated option. A short calendar, sometimes called a reverse calendar, does the opposite. Buy the shorter dated option and sell the longer dated option. So what are we actually betting on? A calendar spread is really a bet on forward volatility, not just on the headline implied volatility of each expiration. When you compare two expirations, the longer dated option contains the volatility of the earlier period and the volatility of the later period that comes after it. That later period is the forward volatility window. So when you put on a calendar spread, you are expressing a view on whether that forward volatility is too cheap or too expensive. We can think of the near period volatility essentially canceling out of our volatility exposures. So when we put on a long calendar, we are buying that forward volatility period. And when we put on a short calendar, we are selling that forward volatility period. We have now established that the core of professional options trading is forming a view on volatility. But having a view is not enough. A professional must be able to isolate and trade that view, separating it from the random noise of the market's day-to-day directional movements. The primary tool for achieving this separation is delta hedging. This section will move from the theoretical world of the BSM model to the practical, messy reality of managing a real-world options portfolio. Understanding the principles and trade-offs of hedging is what elevates a trader from a simple speculator to a true volatility trader. The fundamental goal of delta hedging is to neutralize the directional risk of an option position. When you are long or short an option, you have exposure to many factors, but one of the most dominant is delta, the sensitivity to the underlying stock price movement. This directional exposure can easily overwhelm the more subtle profits or losses from your volatility view. By systematically buying and selling the underlying stock in precise amounts, a delta hedge trader aims to keep their portfolio's net delta at or near zero at all times. The purpose is to transform a position that is sensitive to price direction into one that is primarily sensitive to magnitudes of price movements or volatility and the passage of time. When executed correctly, delta hedging attempts to capture the theoretical profit and loss of a pure volatility trade. For a position that is short volatility, for example, a short straddle, the goal is to realize a profit close to Vega times the implied volatility minus our forecast of realized volatility. This formula represents the edge of the trade. If you sold an option with an implied volatility of 30% and the stock subsequently realizes a volatility of 25%, your delta hedging will, in theory, allow you to capture the value of that 5% difference scaled by your Vega exposure. Mechanically, delta hedging is how that volatility edge gets realized. A short vol position is also short gamma, which means the hedge trades tend to go against you. As the stock rises, you must buy the stock at higher prices, and as it falls, you must sell at lower prices. In other words, a short vol trader typically loses money on the hedge trades themselves because hedging crystallizes the gamma loss. Due to short gamma, if we want to hedge, we are forced to buy high and sell low. The trade still makes money overall if the implied volatility you sold was rich enough relative to the realized volatility that actually occurs. A long vol position is the mirror image. When we're long gamma, we buy stock after it dips and sell stock after it rallies. That buy low, sell high rebalancing is called gamma scalping. For a long vol trader, the hedge trades are often the mechanism that monetizes realized movements and offsets the option's theta decay. The BSM model is built on elegant but fictional assumptions of continuous hedging in a world with no transaction costs. In reality, we cannot trade continuously, and every trade costs money. Therefore, we must choose a practical, discrete hedging strategy. The method we choose will have a profound impact on our final P&L. The first are arbitrary methods, simple but flawed. Time-based hedging is re-hedging at fixed time intervals, for example, every 30 minutes or once at the end of every day. This is simple to implement, but completely arbitrary. It takes no account of what the market has actually done. A quiet market might be overhedged, incurring needless costs, while a fast market might be dangerously underhedged. There's also price-based hedging, which is re-hedging every time the stock moves by a certain amount. For example, every $1 move or every 0.5%. This is slightly better as it links the hedging to market action, but the threshold is still arbitrary. Why $1 and not $1.10? The most common practical method is to set a delta band. A trader might decide to re-hedge whenever their position's net delta drifts outside a predefined range. For example, plus or minus 5 delta. This is more robust than time or price-based rules, but the width of the band is still fundamentally arbitrary. The professional's approach is to use an optimal hedging model. Sophisticated traders recognize that the decision to hedge is an economic trade-off. They use utility-based models, pioneered by academics, to define a dynamic hedging threshold. These models don't use a fixed rule. Instead, they continuously calculate the optimal point at which to hedge by balancing two key factors: the cost of hedging, the transaction costs, commissions, and more importantly, the bid-ask spread incurred by making a trade, and the risk of not hedging, the potential loss being the variance of the P&L from letting the delta drift further from zero. The model finds the point where the marginal benefit of reducing risk is exactly equal to the marginal cost of the transaction. This optimal hedging point is not static. It changes based on the option's Greeks. For example, the model will tell you to use tighter hedging bands when your position's gamma is high, as the delta risk is accelerating quickly, and wider bands when gamma is low. This is a far more intelligent and capital efficient approach than using arbitrary rules. The implementations for optimal hedge bands are available online, and we have an implementation on our position designer on Oquans. However, for traders not using an optimal hedging model, a practical compromise is to let the hedge band depend on whether the position is long or short gamma. For short vol/short gamma positions, it usually makes sense to use wider bands because every hedge can lock in a gamma loss and incur spread costs. A reasonable starting point is 15 to 25 delta, and when the position breaches that band, to hedge partially, often back to the band edge. This means if we were to choose a 25 delta band, and our position delta is now -32, we would buy 7 shares to get back to 25. For long vol/long gamma positions, it usually makes sense to use tighter bands because hedging is part of how the position monetizes realized movement. A reasonable starting point is a 5 to 10 delta band, and when breached, to hedge back to or near zero. These are not universal rules. The appropriate band should be tighter in liquid underlines with low trading costs and wider in illiquid names, wider spreads, or positions where gamma is low. Every hedging strategy lives on a spectrum defined by a critical trade-off between transaction costs and P&L variance. Frequent hedging has low variance and high costs. Imagine you re-hedge every time your delta moves by 0.1. Your portfolio will remain almost perfectly delta neutral at all times. Your daily P&L will be very smooth and will closely track your volatility edge. However, you will be constantly crossing bid-ask spreads, and your transaction costs will be enormous, potentially erasing your entire edge. Infrequent hedging has high variance and low costs. Now imagine you only re-hedge once a week. Your transaction costs will be minimal. However, throughout the week, the stock could move significantly. If you are short a straddle and the stock rallies hard, your delta could drift to -60 before you re-hedge. This creates a large, unhedged directional loss that has nothing to do with your volatility view. Your daily P&L will be extremely volatile and will be dominated by these directional swings, obscuring the profit you are trying to capture from the volatility premium. The optimal point on this spectrum depends heavily on whether you are long or short gamma. For a short gamma trader, overhedging can be especially damaging. You repeatedly buy high and sell low while paying the spread each time. For a long gamma trader, some amount of frequent rebalancing can be beneficial. The goal of a professional hedging strategy is to find the sweet spot on this spectrum that minimizes the total drag on performance and best suits the strategy's objective. Choosing not to delta hedge at all is a valid strategic decision, but you must be clear about what it means. When you buy a call option and simply hold it, you are not making one bet. You are making two simultaneous correlated bets. First is a directional bet. You are betting the stock will go up, a positive delta bet. And second, a volatility bet. You are betting that the future realized volatility will be high enough to overcome the option's time decay. Over a very large number of trades, the law of large numbers suggests that the directional component will average out to zero, assuming you have no directional edge. And the final P&L will still converge towards the theoretical Vega times IV minus RV profit. However, the path to get there will be extremely volatile. The P&L of any single trade will be completely dominated by the stock's price path, not by the volatility dynamics. For a professional trying to run a dedicated volatility portfolio, this level of directional noise is typically unacceptable. The entire discussion above has focused on dynamic hedging, the active, ongoing process of trading the underlying asset. However, there is another way to manage risk. Dynamic hedging is actively trading the underlying to manage delta. It is flexible, but incurs ongoing costs, and most importantly, is vulnerable to price gaps. A dynamic hedge offers no protection against an overnight jump that blows through your delta neutral position. Static hedging is structuring your initial position using other options to predefine your risk profile. This is about risk management at the outset of the trade. The classic example: compare a short strangle with an iron condor. A short strangle has unlimited risk and must be dynamically hedged to manage delta. It is completely exposed to gap risk. An iron condor is simply a short strangle where you have also bought a further out of the money put and call, or a wider strangle. These long options are your static hedge. You have paid an upfront premium for them, which reduces your maximum profit potential. However, they completely cap your risk. You have created a defined risk position that requires no dynamic hedging to protect against a catastrophic loss. The choice between them is a trade-off. Dynamic hedging avoids the upfront cost of buying protective wings, but exposes you to ongoing transaction costs and the unhedgeable risk of price gaps. Static hedging costs you a known amount upfront, which is a drag on your volatility edge, but provides a robust protection against the most dangerous risks. Additionally, like the choice of not dynamically hedging above, we are exposed to the path of the realized stock, and even if realized volatility is less than what we sold, we could still lose because the price trended in one direction. However, another benefit of static hedging is significantly reduced margin. So from a return on margin or collateral perspective, static spreads can often be more attractive than their uncovered counterparts. At this point, you understand the instrument and you understand volatility, but that still leaves the most important question in trading. Why should any trade exist in the first place? Because knowing what options are, or even knowing how volatility works, does not automatically give you an edge. If markets are competitive and mostly efficient, then every trade you put on has to clear a much higher bar than this setup looks good. In this section, we're going to talk about market efficiency, expected value, adverse selection, risk premia, and what it actually means to have a real trading edge. This is the section that shifts the mindset from learning about options to thinking like a trader. Up to this point, we have focused on the what and how of options, their mechanics, their pricing models, and their risks. We are now shifting to the most important question of all. Why should a trade be placed in the first place? This section is the philosophical and strategic core of the entire course. It addresses the fundamental realities of what it takes to be profitable in a brutally competitive environment. Without a deep understanding of market efficiency, expected value, and what constitutes a genuine trading edge, even the most sophisticated knowledge of option structures is useless. This is where we transition from being a student of options to thinking like a professional trader. Let's begin with a blunt and uncomfortable truth. Most aspiring traders lose money. This is not primarily due to a lack of intelligence, effort, or passion. It is because they fundamentally underestimate the primary obstacle they face every single day: market efficiency. The core idea formalized in the efficient market hypothesis is that an asset's price rapidly incorporates and reflects all available information. In a perfectly efficient market, all stocks or options would always be correctly priced. There would be no bargains and no overpriced assets, making it impossible to consistently outperform the market average through stock selection or timing. For a trader, this would mean the expected profit of any given trade is zero before costs. Nobel laureate Eugene Fama, a principal architect of the efficient market hypothesis, was the first to acknowledge that perfect efficiency is a theoretical benchmark, not a description of reality. Real markets are messy, and opportunities for traders exist within the frictions and flaws of the system. A perfectly efficient market assumes zero transaction costs and free, instantaneous information. In reality, every trade costs money, commissions, and more importantly, the bid-ask spread. Acquiring high-quality information and the tools to analyze it is also expensive. These costs create a significant barrier that any potential edge must overcome to be profitable. The efficient market hypothesis often assumes perfectly rational participants. Real markets are driven by a chaotic mix of logic and human psychology. Cognitive biases create predictable patterns of mispricing. Herding, or the tendency for individuals to follow the actions of a larger group, leading to momentum bubbles and crashes that overshoot fundamental value. The disposition effect is the proven tendency for investors to sell winning stocks too early and lock in a small profit, and hold losing stocks for too long, hoping they will come back. Overconfidence and overreaction. Traders often overreact to dramatic, salient news, causing prices to swing far more than new information justifies. As long as humans are involved, their irrational actions will create predictable distortions. Convergence isn't instant. Even when an asset is mispriced, it doesn't instantly snap back to its fair value. The process of professional trading, where smart money pushes prices back in line, takes time and is often risky. The speed of this convergence varies greatly depending on the asset's liquidity, and the complexity of the mispricing. The pockets of opportunity for traders exist in these moments of dislocation and during the path of convergence. Efficiency isn't an all or nothing concept. It exists on a spectrum, commonly described in three forms. The weak form is where all past price and volume data is already reflected in the current price. This implies that technical analysis, the practice of finding patterns like support and resistance or moving average crossovers in historical charts, should not consistently produce an edge. If a pattern truly predicted a price change, automated algorithms would exploit it instantly, erasing its predictive power. The semi-strong form states that all publicly information is reflected in the price. This includes everything from earnings reports and economic data to news headlines and analyst ratings. This implies that reading a positive news story in the Wall Street Journal and then buying the stock should not yield an edge, because the price already adjusted the moment the information became public, likely even milliseconds before you finish reading the headline. The strong form states that all information, public and private/insider, is reflected in the price. This is the most extreme form and is demonstrably false. The very existence of strict laws against insider trading is proof that having access to material, non-public information, like an upcoming merger, provides a massive and illegal edge. The realistic view is a mostly efficient world ripe with pockets of insanity. The truth is that the real world markets are a blend of all three forms, but are not perfectly efficient in any of them. There is compelling evidence that even weak form efficiency is not absolute. Persistent anomalies like momentum, where the largest winners tend to keep winning and the largest losers tend to keep losing, suggest past prices do have some predictive power. Perhaps the most visceral proof of inefficiency is the mistaken identity rally. In the early days of the COVID-19 pandemic, as the company Zoom Video Communications, ticker ZM, became a household name, a tiny, unrelated company named Zoom Technologies, ticker Zoom, saw its stock price skyrocket over 1,800%. This shows that at times, the market cannot even process the most basic public information correctly. The bottom line for a trader is this: assume the market is highly efficient by default, respect it, and do not expect to find easy money. However, know that it is not perfectly efficient. Your job is to hunt for opportunities in the gaps left by behavioral biases, structural frictions, and information costs. These are the pockets where a real trading edge can be found. To succeed in options, one must first dismantle the retail image of trading. Professional trading is not about clicking buttons based on a gut feeling that a stock is too high or too low. It is a rigorous, quantitative endeavor that resembles running a specialized insurance company or a high-stakes logistic firm more than it resembles gambling. Many enter the markets viewing trading as a series of isolated events. I buy this call today, and I hope it goes up tomorrow. This is a fundamental error. Professionals view trading as a continuous process where individual outcomes are secondary to the statistical integrity of the system. The harsh reality is that the vast majority of retail traders lose money. This failure is rarely due to a lack of intelligence. Instead, it is a failure to respect the efficiency hurdle and understand the realities of trading as a statistical process. In a world where billion-dollar funds use microwave towers for millisecond advantages and PhD mathematicians model every conceivable correlation, your dedication is not an edge. You are competing in a zero-sum environment, or after costs, a negative-sum environment, where every dollar you make must be taken from someone else who is trying just as hard to take it from you. Beyond the superficial goal of making money, trading is the exploitation of perceived mispricings. At its core, every trade is an assertion that the market's current price is wrong relative to a more accurate fair value that you have calculated. The core principle is that you seek to buy assets that are underpriced and sell or short assets that are overpriced. In the context of options, this usually means identifying when implied volatility, the price of the option, is significantly different from the realized volatility, the actual movement on the underlying, that will occur over the option's life. The no trade zone. If your analysis suggests that an asset is priced correctly, meaning its market price is an accurate reflection of its future probability distribution, your expected return is zero. Entering a trade here is a mathematical mistake because transaction costs will immediately turn your expected value negative. Professional traders spend most of their time in the no trade zone, waiting for a genuine dislocation. While investors seek to capture long-term economic growth, traders focus on shorter-term probabilistic advantages. We aren't necessarily betting on the success of a company, we are betting on the mispricing of risk. One of the most profound realizations for a new trader is that getting filled is information. In a competitive market, you should always ask, why is my counterparty willing to do this trade with me right now? This is the information asymmetry problem. Imagine a jar filled with an unknown amount of coins. If you offer to buy the jar for $20 and the seller instantly agrees, you should likely be worried. They know the jar only contains $15. In trading, this is called adverse selection. If you put a limit order to buy a cheap option and you are filled immediately, it is often because someone on the other side of the trade does not think it is cheap and likely has more information than you. The seller was happy to fill you because they believe the price is going lower. Your fill is a signal of your counterparty's confidence. You don't need to know everything about the world. You just need to know more than the specific person or algorithm on the other side of that specific trade. If you cannot identify who the sucker is in the transaction, it is likely you. An edge is a demonstrable, verifiable, and quantifiable advantage that results in positive expected value over a large sample of trades. It is your unfair advantage in what is supposed to be a fair game. Think of how a casino has a provable edge in all its games so that gamblers will lose in the long run. Finding, testing, and deploying strategies with positive EV is the single most important task of a trader. Without an edge, everything else is meaningless. Without an edge, no amount of discipline, psychology, or money management will save you. You cannot manage your way out of a negative EV game. You must define your edge before risking a single dollar. If you can't explain your edge in 2 sentences to a child, you probably don't have one. Why is the market paying you? What value are you providing? Trading for excitement, to relieve boredom, or to prove the market wrong is a path to ruin. Professional trades are motivated solely by the identification of a plus EV opportunity. Good trading is boring. If you are not using data to validate your ideas, you are flying blind. Professional traders rely on backtesting and data to understand the boundaries of their strategies. Quantification provides objectivity. It removes the emotional feel of a trade. You are simply executing on the work you have already done. The actual placing of the trade and managing it is often the least amount of work in the process. It allows you to estimate, not just if you will make money, but how much you stand to lose in a worst case scenario. It gives you an idea of potential P&L paths your account can take so that you are not fearful in drawdowns or greedy in periods of overperformance. It also gives you a framework to prove yourself wrong. A professional trader is a scientist trying to disprove their own hypothesis. If the data doesn't support the edge, the strategy is discarded. In hyper-liquid markets like the S&P 500, the efficiency is near perfect. As a retail or small quant trader, trying to find an edge in the 1-minute SPY chart is like trying to find gold on a sidewalk that millions of people walk over every hour. The giants, or high-frequency traders and massive quant funds, have already picked up every crumb. So where can smaller traders find opportunities? We can look to pick up the crumbs. The first is high-capacity risk premia, getting paid to warehouse risk others do not want to hold. We can look at longer time horizons. HFT and quant firms dominate the millisecond, second, minute, and daily levels, and trying to compete with them is a fool's errand. They spend billions of dollars on data, infrastructure, and top talent. Their edge and focus dissipates as you move to weeks and months. We can look to niche markets and less liquid assets. A $10 billion fund cannot trade a relatively small cap company's options because their size would move the market 20% against them. A retail trader with a $500,000 account can enter and exit these illiquid niches without moving the price, exploiting small inefficiencies that are too small for these giants. We can also look for unique events. Situations like complex spin-offs, index rebalancing, or specific regulatory changes often create localized mispricings that require qualitative judgment that algorithms may struggle to price correctly. We can also take advantage of behavioral edges, exploiting the systematic biases of the uninformed public, such as the tendency to overbuy protective puts after a market crash due to the availability heuristic. In a classroom, a trade looks like buy at $1, sell at $1.10 for a 10-cent profit. In the real world, cost eats your edge for breakfast. We have the visible costs, like commissions and exchange fees, and the hidden costs like the bid-ask spread and slippage, the difference between the price you actually see quoted versus the price you get filled for. If you trade an option with a 10-cent spread, you are essentially starting the trade down 10%. Your edge must be massive enough to overcome this friction. The reality is we can likely get filled somewhere in the middle of the spread, but nonetheless, on a mark-to-market basis, we will show a loss if we wanted to guarantee immediate exit and we'd have to hit the bid or lift the ask. Financial markets are adaptive systems. If you find a way to make money, others will likely eventually notice. As more people pile into the same trade, the mispricing gets arbitraged away. For example, imagine a signal that suggests an option is underpriced by 5%. As more traders use this signal, they all try to buy. The ask price rises until the option is no longer underpriced. Sometimes, the quotes change before a single trade is even executed, simply because the market-making algorithms have also learned the signal. Survival requires continuous learning. If your strategy worked in 2022, there is no guarantee that it will work in 2026. You must constantly refine your models, search for new niches, and adapt to the ever-shifting landscape of market efficiency. In an efficient market, if you are not learning and improving, others are, and that means you are falling behind. If markets aren't a perfectly efficient, unbeatable puzzle, how do we systematically identify and exploit their flaws? The answer lies in the concept of expected value. This is the mathematical foundation upon which all professional trading and gambling is built. Expected value is the statistical average outcome of a given bet or trade if it were repeated an infinite number of times. It is the weighted average of all possible outcomes. It can be expressed as the probability of winning times the amount won minus the probability of losing times the amount lost. Expected value is a long-run average, not a prediction of what will happen on the very next trade. A positive expected value trade can still lose money in the short term, and a negative expected value trade can still produce wins in the short term. The goal in trading is not to win on every single trade. It is to consistently place trades where the odds are in your favor, and then allow the law of large numbers to work over time. It is also important to understand that in pure expected value terms, win rate by itself does not matter. A strategy could win only 2 out of 10 trades, but if those winners are large enough to cover the losses, the strategy is still positive expected value. On the other hand, a strategy could win 95 out of 100 trades, but if those losing trades are large enough to wipe out the account, the strategy is still negative expected value. This is what makes high win rate strategies so deceptive. Many traders are drawn to them because they feel safe and consistent, but when the loss finally comes, it can be catastrophic. A dangerous misconception, especially among developing traders, is that good risk management is itself an edge. It is not. Risk management is the essential discipline that prevents you from going bankrupt while you allow your edge to play out, but it cannot turn a losing strategy into a winning one. Let's make this crystal clear with the roulette example. You are at a standard American roulette wheel, which has 18 red slots, 18 black slots, and 2 green slots, for a total of 38 slots. You decide to bet $100 on red. If it lands on red, you win $100. If it lands on black or green, you lose $100. Let's calculate the expected value of this bet. Our probability of winning, or that it lands on red, is the 18 red slots divided by the total amount of slots, or 38, for a total probability of 47.37%. The probability of losing, if it lands on black or green, is the sum of the black and green spots, or 20, divided by the total number of slots, or 38, for a total of 52.63%. We can calculate our expected value by multiplying our probability of winning times the amount we win, minus our probability of losing times the amount we lose. This gives us an expected value per $100 bet of $5.26. This is a negative EV game. The casino has a mathematical edge. For every $100 you bet, you can expect, on average, to lose $5.26. So let's implement a risk management plan. You decide to be a disciplined roulette player. You start with a $10,000 bankroll and implement a strict risk management rule. You'll risk no more than 1% of your capital on any single spin, or $100, and you will stop for the day if you suffer a 5% drawdown, $500, or 5 consecutive losses. This plan sounds professional. It will certainly prevent you from losing your entire $10,000 in a single disastrous day of reckless betting. But what has it done to your expected value? Absolutely nothing. The EV of each individual spin is still negative $5.26. Your disciplined plan has not changed the fundamental mathematics of the game. All it has done is change the path of your losses. Instead of losing money quickly, you will now lose it slowly and methodically, one disciplined $100 bet at a time. The lesson is this: risk management is your lifeline. It is your seatbelt and airbag that allow you to survive the inevitable bumps and crashes along the road. But it is not the engine. Edge is the engine. Without a plus EV engine, you are just a well-protected passenger in a car that is slowly and inevitably rolling downhill. Finding an edge is hard. Keeping it is even harder. Edges in financial markets are not static. They are dynamic and constantly under attack. Edges decay. Markets are adaptive systems. When a profitable inefficiency is discovered, other traders will rush to exploit it. As more capital floods into the trade, the mispricing gets corrected, and the original edge is arbitraged away. Edges are noisy. Even a real edge will have periods of underperformance. A strategy with a long-term positive EV can still experience gut-wrenching drawdowns. It's crucial to distinguish between normal variance, a string of bad luck in a plus EV game, and a sign that the edge itself has disappeared. This requires constant monitoring and statistical analysis. Drawdown is inevitable. Even with a real edge, you'll spend most of your time in a drawdown, not at new highs. That is the nature of trading. Equity curves only occasionally make new highs. Most of the journey is spent below them, recovering from losses or moving sideways. Drawdowns are not a sign that something is broken. They are a normal part of any probabilistic edge. In the two examples, we generated 20 random trading outcomes with the same 5% expected value per trade and same standard deviation of returns to illustrate expected value in short versus long terms. In the short term, randomness dominates. Even a positive EV strategy can look bad for long stretches and spend plenty of time underwater. Over a larger sample, however, the noise starts to wash out and the results begin to converge towards the expected value. Some paths will still underperform the EV line and others will outperform it. But the longer the game is played, the more visible the underlying edge becomes. That is why trading must be approached as a long-term game. Your edge only reveals itself clearly over many, many trials. Now that we have established the absolute necessity of a positive expected value, we must explore the two primary pathways to achieving it. Every successful, sustainable trading strategy can be categorized as either harvesting a risk premium or exploiting an inefficiency. These are the two fundamental sources of edge in financial markets, and understanding their profound differences is key to building a durable career as a trader. This is the most foundational and persistent source of returns in all of finance. It is not about being smarter than the market or finding a secret fleeting pattern. It is about willingly accepting a fundamental, undiversifiable risk that other market participants are willing to pay to avoid, and systematically collecting compensation for bearing that risk. You are, in essence, acting as the insurance company for the entire market. A risk premium is the excess return you earn for warehousing a risk that others pay to offload. You are providing a critical service to the market, risk absorption, and getting paid a fair price for it. To understand this, we must first establish a baseline, the risk-free rate. This is the return you could get from an investment with virtually zero chance of default, like a US Treasury bill. Any investment that carries a risk of loss must offer a higher expected return to attract capital. Why would you invest in something risky if you could earn the same return in something risk-free? That extra expected return is the risk premium. Let's look at some characteristics of risk premia. They are persistent. Risk premia, like those for equities and volatility, tend to exist over very long periods because they are rooted in fundamental economic principles and structural risk aversion. As long as humans fear loss, these premia will exist. They have high capacity. These strategies can often absorb very large amounts of capital, which is why they form the core of portfolios for large institutions like pension funds and hedge funds. They are well known. They are not secrets. Their existence is the bedrock of institutional finance. The edge is not knowing they exist, but in developing the skill to manage the associated risks and the discipline to time your exposures effectively. Let's dissect the two most important risk premia for an options trader. The equity risk premium is the most commonly known risk premium and likely one that everyone watching is exposed to. It is the excess return that investing in the broad stock market provides over the risk-free rate, and it represents the compensation investors demand for taking on the fundamental risks of owning businesses. To understand why this premium must exist, consider the crucial distinction between owning a company's stock versus its bonds. When you buy a bond, you are a lender. You have a legal, contractual right to receive interest payments and the return of your principal at a specific maturity date. Your potential return is capped and defined. During bankruptcy, you are closer to the front of the line to be paid. When you buy a stock, you are an owner. You have a residual claim on the company's future profits, which are completely uncertain and only paid out after all other obligations, including debt, are met. In the unfortunate event of a bankruptcy, there is a strict pecking order for who gets paid from the company's remaining assets. Bondholders, as lenders, are near the front of the line and may recover a portion of their investment. Stockholders, as the ultimate owners, are dead last. If the company fails, they are almost always left with nothing. Because of this massively higher risk profile, no rational investor would choose to own stocks if they only offered the same expected return as a safe government bond. To be induced to take on the risk of total loss and the uncertainty of future profits, investors demand a higher potential reward. This structural demand for compensation is what creates the equity risk premium. It is not a market inefficiency, it is the fair, rational price for bearing the fundamental risk of capitalism. Now let's look at the variance risk premium, or VRP. Just as stocks must offer a premium over bonds, selling options as a strategy typically offers a premium over simply owning stocks. The variance risk premium, or VRP, is the well-documented phenomenon where an option's implied volatility is, on average, higher than the subsequent realized volatility. This means that option sellers are systematically paid a premium that more than compensates for the statistical risk they are taking on. This premium exists because the risk profile of being short volatility is fundamentally different and scarier than the risk of just owning stock. If you own a stock and it falls by $1, you lose $1. Your loss is linear and proportional to the move. Your risk is easy to compute and conceptualize. If you are short a straddle and the stock falls by $1, you lose a certain amount. But as it continues to fall, your position's delta becomes more negative due to negative gamma, causing your losses to accelerate. This convex, non-linear risk profile is particularly unattractive and difficult to manage during a market crash. You are not just losing money, your rate of loss is increasing with the size of the move against you. The flip side of the return distribution is positive gamma, where losses decelerate and gains accelerate. This is a very attractive risk profile. As a result, option buyers are systematically willing to overpay for this. When you own a stock, your max loss is capped. The stock can only go to zero. If we sell a naked call, for example, your potential loss is theoretically unlimited. Let's look at gap risk. A long stock position is not existentially threatened by an overnight price gap. A short volatility position, however, is terrifyingly vulnerable. A dynamic delta hedge, as we discussed, assumes continuous price movement. A large, discontinuous gap from an earnings surprise or geopolitical event makes hedging impossible. The position can suffer a catastrophic, unmanageable loss in an instant. It is because of these frightening characteristics, the accelerating convex losses, and the vulnerability to gaps, that most market participants want nothing to do with selling options. This creates the same supply and demand dynamic we saw with the equity risk premium, driving the price of options up systematically, but on a different, more complex level of risk. Think of the VRP as the profit margin of a global insurance company for financial risk. The insured consists of institutional portfolio managers, pension funds, and anyone structurally long the stock market. They are terrified of left tail events or crashes. To protect their portfolios and sleep at night, they are persistent, structural buyers of options, especially puts. They are often willing to pay more than the fair statistical price for this protection, treating it as a necessary cost of doing business. The insurer is the volatility seller. You are stepping in to provide this insurance. You are telling the market, I will take on the risk of a crash that you are so afraid of, but you must pay me for it. No rational insurer would sell a policy for a price equal to the expected statistical payout. They must charge more to cover their operation costs, their risk of ruin, and to generate a profit. The VRP is precisely this extra charge. The consistent overpricing of IV relative to RV is the market's fair price for compensating sellers for taking on the terrifying, non-linear risks that everyone else is paying to avoid. Harvesting risk premia is a robust path to edge because it is rooted in the fundamental structure of markets and human psychology. It is not about finding a secret. It is about having the capital, skill, and fortitude to act as the market's insurer. If harvesting risk premia is like being an insurance company, exploiting inefficiencies is like being a detective. It involves actively hunting for temporary dislocations where an asset's price has deviated from its fair value. Formally, an inefficiency is a temporary deviation from fair value caused by market structure, behavioral biases, or information lags. You are adding information to the market, that is, making the market more efficient, by pushing prices back to where they belong. Some examples of inefficiencies would be post-earnings announcement drift, a well-documented anomaly where stocks that have large positive earnings surprises tend to drift higher for days or even weeks afterward as the market slowly digests the new information. This shows that convergence isn't instant. Index rebalancing. When a stock is added to a major index like the S&P 500, index funds are forced to buy it, often creating predictable upward price pressure in the days leading up to the rebalance. The most common example for options traders would be mispriced volatility in single name equities. While broad market indices tend to be highly efficient, the options on individual stocks, especially those outside the mega cap heavily traded names, are fertile grounds for finding mispriced volatility. This is a prime area for inefficiency hunting. This mispricing stems from several sources. Information asymmetry and lags. Unlike a stock like Apple, which is scrutinized by hundreds of analysts, smaller companies have much less coverage. New information disseminates more slowly, and its impact on volatility can be under or overestimated by a less informed market. In less liquid options chains, the price can be temporarily distorted by the actions of a single large participant. If a single fund needs to buy a large amount of downside protection, they can single-handedly bid up the price of puts, causing the IV and Skew to spike to irrational levels. Fear and greed have a much more pronounced effect on individual stocks. A positive news story can lead to a FOMO-driven spike in call IV that is completely disconnected from a rational volatility forecast. Similarly, bad news can cause panic, leading to put IVs that imply an unrealistically high probability of bankruptcy. To capitalize on this, a professional trader uses a systematic valuation process, assessing the price of volatility through two primary lenses: absolute and relative analysis. By comparing an option's IV to its own history, or an absolute valuation, and to its logical peers, a relative valuation, a trader can move beyond simple guessing and identify specific, quantifiable reasons why a particular stock's volatility might be mispriced, creating a clear and defensible trading opportunity. Let's look at some characteristics of inefficiencies. They tend to be fleeting. These edges tend to decay quickly as they are discovered and arbitraged away. Usually one-off trades. Either we are right in our forecast and close for a gain, or wrong and close for a loss. These are not trades that are consistently put on over and over again on the same underline, like risk premium trades would be. They are low capacity. They often exist in less liquid markets and are too small for large institutions to bother with. This is where a nimble retail trader can have an advantage. They require discovery. Unlike risk premia, these are not obvious. They require skill, research, significant time investment, and a unique perspective to find and exploit. The distinction between risk premia and inefficiencies is not just academic. It is the core of building a sustainable trading business. A professional trading operation, like any other business, requires a consistent and repeatable source of revenue. Businesses are built on risk premia. They are the systematic, ever-present sources of positive expected value that you can build a portfolio around. You can wake up every day knowing that the market will likely offer a premium for selling volatility or owning equities, and you can structure your business to consistently harvest that premium. Exploiting inefficiencies, on the other hand, is opportunistic. You cannot build a business plan around an edge that might only appear a few times a year and could disappear forever once discovered. These are valuable opportunities to seize when they arise, but they are not the foundation of a durable trading career. Harvesting risk premia is like owning a portfolio of commercial real estate. Your business model is to collect rent from your tenants. This is your structural premium. You know with certainty that you will have costs, vacancies, repairs, tenants who default, which are like taking losses on some of your short volatility trades. However, because there is a structural demand for commercial space, you know that over your entire portfolio and across time, the rents collected will outweigh the costs, generating a consistent, predictable income stream. This is a durable business. Exploiting inefficiencies is like being a house flipper who only buys deeply distressed properties at auction. You might find a house worth $500,000 that you can buy for $250,000 because of a foreclosure or a temporary inefficiency. You can make a massive profit on that single deal, but you cannot build a reliable business on this model because you have no idea when the next distressed property will become available. It is a fantastic opportunity when it appears, but it is not a consistent source of revenue. A professional trader builds their core portfolio, their business, around the consistent, repeatable income stream of harvesting risk premia. Then they keep their eyes open for the opportunistic, high-profit house flips of market inefficiencies, taking them when they appear, but never relying on them for their survival. Now, let's move on from theory and into the real world. Up to this point, we've built the conceptual framework, the contract, the pricing, the Greeks, volatility, expected value, and edge. But none of that matters if you can't translate it into actual execution. So in this section, we're going to look at real option chains, real brokerage workflow, order placement, liquidity, margin, position sizing, and how to actually evaluate and place trades in practice. We'll look at real examples and show how to analyze trades around the variance risk premium. This is where the course stops being theory and starts becoming a trading process. I set up an account here on Interactive Brokers with around 110 US dollars, 100,000 being USD, and around 14,000 Canadian. I set up this account to show some trades in this video, and with the plan of doing some more real trading videos or trading challenges in the future. If you have anything you want to see related to this, let me know in the comments. Now, I am located in Canada, and all of the overall account figures will be in Canadian dollars. So when we look at these margin numbers up top, and any margin quotes for trades, keep in mind that they will be shown in Canadian dollars, which at the current exchange rate is worth about 0.72 US dollars. The first number we will look at is net liquidity, also called net liquidation value or NLV. This is the mark-to-market value of the account if all positions were liquidated at current prices. If there are no positions open, it is simply the Canadian dollar equivalent of the cash held in the account. Maintenance margin is the minimum equity required to continue holding the current positions. As we open positions, this number will change based on the risk of those positions. Excess liquidity is our margin buffer. At Interactive Brokers, it is best thought of as equity with loan value minus maintenance margin. In a simple account with no borrowing, this will often feel similar to the difference between our net liquidity and our maintenance margin. But the exact broker definition matters. When excess liquidity falls too low or turns negative, positions may be liquidated. It is important to note that these numbers are not static. They change as prices move, as volatility changes, and as the broker adjusts its internal risk requirements. For Canadian residents at Interactive Brokers, the account is on a rule-based margin framework, and portfolio margin is not currently available. That generally makes the account less forgiving than a true risk-based portfolio margin regime. On top of that, losses on positions reduce our NLV, which also reduces excess liquidity and shrinks our margin buffer. Brokers can also raise house margin requirements at their discretion, often without notice, which is why margin must be monitored continuously. That brings us to reasonable margin guidelines. These are not broker rules, but practical risk management guidelines. They depend heavily on how hedged the overall portfolio is. For a general volatility book, that is mostly short options and structurally short volatility, a useful baseline is to keep maintenance margin around 30% of the net liquidation value. For a well-diversified portfolio with real crash hedges and some long volatility exposure, 35 to 45% can be acceptable. In general, if maintenance margin reaches around 50% of our net liquidation value, that is usually a sign to start de-risking so that a volatility spike or broker margin increase does not force liquidation. Margin on positions also matters a lot for capital efficiency and overall returns. For example, if we have the same theoretical edge on one position that requires $10,000 in maintenance margin and another that requires only $2,000, all else equal, the $2,000 margin position would show a 5x higher return on margin. In that sense, it is more capital efficient. That being said, return on margin should not be looked at in isolation. We still need to consider the absolute risk of a trade, the tail risk, the liquidity, and how the position fits into the overall portfolio. A trade with lower margin is not automatically better, but when two trades offer similar edge and similar risk, the one requiring less margin is generally the more capital efficient choice. I will show this shortly using some real positions. Now let's look at some features that are predictive of VRP. I'm going to be using OQuants to run these tests, but I've also run some other more custom backtests and modeling in some of my other videos on the channel. If you're interested in learning more about statistical modeling and backtesting, since that is a little beyond the scope of this course and likely a full course in and of itself, let me know in the comments. For these features, we are looking at all ETFs and stocks with a minimum underlying price of $10, a 20-day average option volume of 25,000 contracts per day to ensure option liquidity, and we avoid trading through earnings events. Looking at the 30 DTE straddle return on margin versus the IV over RV ratio, we can see that in general, the higher the IV-RV ratio, that is the current IV versus the backwards looking RV, the better the straddle return on average. This shows that using backwards looking RV as a reasonable proxy for future RV is a decent baseline assumption. Next, we look at the 30 DTE straddle return on margin versus the 1-year IV percentile. It shows that the lower the IV percentile, in general, the better the return. Lastly, looking at term structure slope, the more positive the slope, meaning contango term structure, the better the return. If you want to see more about the research behind these features, I have another video here. It's important to remember that these are generalities, and we should still assess each potential trade and its underlying situation before taking a trade. Using these features and a model, we curate a screener on the OQuants homepage that shows tickers that meet these criteria. So let's start by taking a look at IBIT. So IBIT tracks Bitcoin's spot price, and as we can see recently, the Bitcoin price has fallen quite a bit. But we can also see that in the past month or two, it's kind of chopped sideways a little bit here. So if we take a look at the term structure, what we notice is that the RV, or the recent realized volatility, is falling sharply, but we can see that the IV is still relatively high and sticky. Taking away the RV for a second, we can also see the shape of the term structure is clearly upward sloping and in contango, which is generally a good predictor of future short volatility returns. Now, if we take a look at the IV percentile versus VRP, the regression line shows us that the higher the IV percentile, the worse the variance risk premium. And since we are relatively high here, that is a little bit of a contradictory sign for short volatility returns in the future. However, we can also note that in the recent past 10 days, it's moved up and started clustering in a positive VRP range. If we take a look at the variance risk premium chart as well, the actual realized VRP, so this is the IV versus lagged RV, so the IV at the time versus the subsequent realized volatility, we can see that the current ratio, or the most recent value, is around 20%, and it has a mean of around 15%. So blindly selling volatility on IBIT, historically, would have been profitable. If we take a look at the non-lag ratio, or the current IV over RV, we can see it's currently around 11%, with a mean also near 15%. So both of these things indicate that there is likely a positive VRP on this trade in general. Now going back to the term structure graph, given this relatively high sticky IV and the falling RV, it looks like there's potentially a good opportunity to sell volatility here. Now, if we take that as the baseline edge for this trade, we can go price out what this looks like in a short volatility position. So let's start by building an at-the-money straddle. So we're going to find the expiration nearest 30 days here is what we were looking at on the volatility page. And we'll sell an at-the-money straddle, which are generally the contracts nearest to the 50 delta here, or the nearest strike to the underlying price, which is around 39. So if we look to sell an at-the-money straddle, we get this position. Now we can see, as implied by these contracts, the current IV is around 52%. And taking the baseline RV assumption of around 45%, we can forecast what our edge is on this trade. Entering 45 as our forecast for RV, taking the past 30-day RV as a baseline and running that, we can see that our mean return is around 13% and our Kelly fraction around 30%. Now, in general, these Kelly fractions are going to be much larger than what we would actually want to trade, but we'll talk about sizing in a second. Now, we also have this effective fill IV calculator here. So this allows us to enter a price for a spread, and it will tell us the effective IV we actually sold. And this is useful for when we go to actually place orders in order to not chase a fill. We'll cover that in a second. Now, if we wanted to do a covered position, so an iron condor, for example, we could build something like this. For instance, we could sell the 37 put around the 35 delta, the 41 call around the 39 delta, and then go and look to buy cheap wings. And now the reason we want to buy cheap wings is to not eat into our edge too much, and I'll show that in a second. So we'll buy this 8 delta put here, and we'll buy this 8 delta call here as well. So that gives us our iron condor position here. Now, if we take that same baseline RV forecast of around 45% and run that, we'll get an estimated edge here of around 11.6%, which is slightly less than the straddle. And the reason it's less is because we are financing this protection by buying these two out-of-the-money wing contracts here as protection. Now, when we're taking short volatility trades, our opinion is that volatility implied by the market, implied volatility, is overpriced. So when we go and we purchase these contracts, we are implicitly overpaying because our thesis is that volatility is too high, and yet we're still going and buying volatility in these wings. Another reason this eats into our edge a bit as well is due to the volatility skew. As we can see by the skew here, normalized by the call delta, this being out of the money calls, this being out of the money puts, we can see that the put side IV is considerably higher than the call side IV. So by buying the wing, which is somewhere around here, we are actually paying a large premium in implied volatility for this protection. So we're selling near the 50 delta around in this area, which has an IV, which is significantly lower than the wing we're buying out here, which can also eat into our edge. Well, let's talk a little bit about what would cause us to exit this position early whether for a loss or for a gain. So if this RV was to start spiking back up to a point where it was actually above or approaching above the volatility we sold, at that point we can call the trade invalid because it actually started realizing more than what we sold. So at that point, it would make sense to exit. Likewise, if we got this IV to drop to our baseline volatility of around 45% for this RV, that would show that the market converged to the RV we thought was fair, and we should exit the trade at that point as well. Another factor that could lead us to exit this trade early is drift. So whenever we're short volatility, drift is our enemy. If the price starts to drift in either direction, whether that's down or up significantly, it could actually be realizing less volatility than we sold on the path, but because it's drifting in a single direction, that can still result in a loss. Now, in the case of a straddle, we can actually hedge this drift away better than we can with a static position like a condor. Next, let's look at GME, which showed up on the stock VRP screener. Looking at the IV percentile versus VRP graph here, we can see that by the regression line, GME has a pretty consistent VRP, regardless of the level of IV percentile. It's positive here, and it's positive here. It's actually slightly larger at higher IV percentiles, but nonetheless, at low IV percentiles, VRP is still positive, and we can see the recent points clustering above in the positive VRP range. If we look at the IV versus lagged RV, so the actual spread of what happened historically, we can see the mean is around 18% and the last value is around 46%. So there is a consistently high VRP on GME. Now, if we switch to the non-lag version, so the IV over current last period RV, we can see the mean around 14% and a current value of around 16%. Now, going down to the term structure, we can see the general shape is contango and upward sloping, especially from our 30-day baseline here, which we're going to look to sell. We can also see that RV is falling, and there's a considerable spread between last period RV and current implied volatility. All these signals point to a good short volatility opportunity. If we look at the skew, we can see there's skew in both directions, so especially on the call side. We know that GME is a very high retail interested stock. I'm sure everyone's aware of the run it made a few years ago. And as a result, we have a lot of retail traders consistently bidding up and buying out of the money call options, which ends up pushing this call skew upwards. Now, in general, if you ever have a very retail interested name with a lot of price insensitive option buyers, generally there will be a good short vol opportunity there. Something we'll notice in a second when we go and build these positions is due to the skew, if we choose to open a static structure, we're going to be paying a lot more for the wing protection than we'll be selling near the center. Now let's go price out some positions on GME. So again, looking at the 30-day expiration, let's start with an at the money straddle. With the current underlying price around 22.5, we'll look to sell near the 50 delta, which is around the 23 strike. So that gives us our straddle here. Again, using the 30-day most recent realized volatility as our baseline forecast volatility metric. So if we put that into the RV scenario analysis at 32.5, we can see that our mean return is around 11. And again, a Kelly fraction around 25%, which we'll talk about shortly, but is way too high and much higher than you'd actually want to take a position like this in. Now let's also look at a condor or a static structure for GME. So we can sell the 22 put in and around the 35 delta, the 24 call in and around the 35 delta, and then go and look for those cheap wings. We can go buy this 5 delta call at the 29 strike. To make this a balanced structure, the equivalent put strike would be around this 1 delta here at the 17 strike. So that gives us this condor here. And what you'll notice between this and the IBIT condor is from a risk reward point of view, this looks much less attractive than the IBIT condor. And the reason for this is the amount we're going to be paying for these wings due to the skew. And so again, if we go and type in our baseline RV assumption, which was around 32.5, and run this, we'll see a mean return around 10%, which again is lower than the straddle because of the wings we're financing. So likewise with the IBIT example, we'll look to exit early if this IV comes down to our baseline RV assumption, or if this RV starts coming up towards the IV we sold. Either way, the trade is either validated and we got our profit, or invalidated because the RV was actually higher than the IV we sold. Similar to the IBIT example as well, drift is our enemy. And so if we drift slowly, even if the drift of the underlying price, if that RV is less than the IV we sold, due to the drift, we can still end up losing. And so if we drift too far in a single direction, or if our IV RV conditions are met, we will look to exit early here. So in terms of sizing, I mentioned that this Kelly fraction is much too large, and there's a few reasons for that. First and foremost is that in general, the Kelly fraction is uncomfortably large because all Kelly is trying to do is maximize terminal wealth. So it's not concerned with the actual path your P&L or portfolio takes. It's only concerned with maximizing the final value. And as a result, if you're to bet at full Kelly, portfolio variance, your P&L, can be large. 50+% drawdowns doesn't matter as long as the end value is big. And this is just a very uncomfortable P&L trajectory for most people and just not very sustainable in general. So I have some other videos on the channel if you're interested in seeing some of the P&L paths and drawdown statistics from full Kelly betting. The second reason why this is too large is how this simulation is run. So this simulation runs price paths using geometric Brownian motion, which has an embedded normality assumption. So it assumes that future price changes are normal. And as we know from previous sections of the course, is in reality, the real distribution looks something like this, with much more tail weight, so it can actually move much further than implied by normal, and negative skew typically isn't normal, and real price distributions have fat tails and can actually move a lot more than would be implied by normal here. So as a result, a general recommendation is to use a Kelly fraction that is around 5 to 10% or less of this Kelly fraction here. So being conservative here and taking the 5% range, we get 5% times 30% or 1.5%. So to size this trade, we'd want to sell around 1.5% of our account value in premium for this straddle. Now, given that the account value we have on hand here is currently $110,000, that means we'd want to sell around $1,700 in premium for this trade. So that's $1,700 with this current fill price from the options chain is about 4 lots. So 4 of these straddles. Now, usually I'd go through the same sizing with the rest, but to keep this consistent and for comparative purposes, I'll just use 4 lots on everything. Something else I'm going to do for illustration purposes that I wouldn't do either is I'm going to sell 4 lots of everything, which means 4 lots of this condor, 4 lots of this straddle, and the same on GME. In reality, if you were trading this, 4 lots of the straddle plus 4 lots of the condor, you are essentially trading the same short volatility position at double the size. So this is not something that's recommended. I'm just doing this to illustrate the differences between these static structures and the uncovered structures like the straddle if delta hedging comes into play. So let's go ahead and execute these orders now. Okay, so we're on the Interactive Brokers account here with the same account shown previously, and we have the GME options chain open with the April 24th, 29 DTE expiration selected. Now let's start by building this straddle, which we priced out on OQuants previously. So the first thing we'll notice is that the bid-ask spread has around a 40-cent width. Now, when it comes to options, a 40-cent spread width is not necessarily uncommon. So that doesn't mean we're going to have to sell for the smallest credit at negative 1.79 per lot, but we will have to sit on the order book and work our order to try to get the best possible fill. So we can see the margin impact is around 25,000 Canadian dollars for 4 lots of this straddle. Now, if we open up the margin window here, we can see that the initial margin, which is the number meaning the amount of margin it takes to open the position, and then we also have the maintenance margin, which is once the position is open, how much margin it will consume to remain open. So all else being equal, it is very common and typical to see the initial margin being around 2 times what the maintenance margin is. And that's where the max 50% maintenance margin recommendation comes from, is the maintenance margin can easily jump up towards that initial margin, given a volatility shock or due to a rule-based margin hike by the broker. So now we can go ahead and build our 4-lot iron condor, which we built on OQuants. And the first thing we'll notice is that the margin impact is considerably less. So instead of the $25,000 for the 4-lot straddle, it is now 3,000 Canadian dollars for 4 lots of the iron condor. This is important to remember because depending on your margining scheme, a lot of times, even though by buying the wings we are giving up some of our volatility edge, a lot of times it can be worth it if it significantly decreases our margin impact and increases our return on margin. Okay, so we place both those GME spreads near the bid, which likely won't get filled, but I'll show us working those orders and walking those orders down shortly. Now let's build out the IBIT positions. So first, building the IBIT short straddle, there's two things we notice first and foremost. First is that the bid ask on IBIT is much tighter. This is because IBIT has much more option volume, much more open interest, and as a result, gets quoted tighter than GME would. So we can say that IBIT is more liquid than GME. The second is the margin impact. We can see the margin impact is about half of what it was for GME. This is despite selling significantly more premium and IBIT being a higher priced underlying. So when it comes to margin efficiency, our potential edge on margin here is likely higher with IBIT than it is on GME. Next, we can build out our 4-lot iron condor on IBIT. And again, we can see a much tighter spread than we saw on the condor with GME. And second is the margin is actually slightly higher than the margin on GME. And this is because covered structures are margined differently than uncovered structures. So we submitted both of those IBIT orders at the bid as well, and now we need to work them to actually get filled. So in reality, we are much more likely to get filled near the mid of the spread than near the bid at where they're currently placed. So we'll start slowly walking these orders down by decreasing the amount of credit we receive by a couple cents each time until we get filled. So for the GME Iron Condor, that's us getting filled for an average of 99 cents per spread in credit. For the IBIT Iron Condor, that's us getting filled for a $2.34 credit per spread. For the IBIT Short Straddle, that's us getting filled for a $4.50 credit per spread. And for the GME Short Straddle, that's us getting filled for a $1.99 credit per spread. So something we notice and is very typical for entering option spread trades is upon entry, almost always, our instantaneous unrealized P&L will be negative. So this is due to the wider spreads of options and the mark price being near the mid. Often, by the time we get filled, our unrealized P&L at the moment of entry will likely be negative. So looking at our margin, we can see we have around 30,000 Canadian dollars in maintenance margin, and our excess liquidity is around 128.7 Canadian dollars. As a fraction of our maintenance to net liquidity, we're around 20%, so well within the range that I recommended previously. And again, in reality, we would never open an Iron Condor and a Short Straddle simultaneously. This is just for illustration purposes. You would likely only open one of them. And further, most of that margin is being eaten up by the uncovered Short Straddle structures. If we're under rule-based margining and not portfolio margin, sometimes giving up a little bit of edge to go with a wide covered structure like an Iron Condor or Iron Butterfly can be advantageous from a margin perspective. One thing you may be wondering is, how did I know what price to walk the order to? How did I know when to stop walking the order? Well, I didn't. And that's what this calculator here is for. And it's something you should always check before you walk the orders. So if we look at what I actually sold this GME Iron Condor for at a fill price of 99 cent credit per spread, it was 35.23% effective fill IV. So if we remember from the volatility page for GME, the 30-day at the money IV was around 38.5. So what we can see is by walking the order down, as well as buying the wings, we actually only sold an IV of around 35.23%. And with our estimated fair value at around 32.5, we have only about 3% of IV edge in this trade. Now, if we go to the straddle and we type in our effective fill price, which was $1.99 of credit, we can see our effective fill IV is around 38.5, which is substantially higher than with the Condor. So these are the trade-offs we live with when we decide between an uncovered structure like a straddle or strangle, which typically we give up less edge. As we can see here, we sold a much higher IV than with the Condor, but the negative being a significantly higher margin requirement. And so we must always look at our effective fill IV and potential edge versus the margin that's used to capture that. In a lot of cases, it can actually make sense to give up some of that edge and go with the covered structure depending on your margining scheme. So with our GME Condor here, I really wouldn't want to capture anything less than the IV we sold here. If due to wide spreads, we kept walking our order down to say 85 cents of credit, then our effective fill IV becomes 32.2, which is less than the RV we were using to benchmark this position. And as a result, just by entering this trade, we have implicitly entered a trade by chasing price that is giving us an effective sold IV of less than the RV we were using as our forecast. So it's important to check what our actual fill IV is in order to not chase orders. In the IBIT case, if we look at our iron condor here, we got an actual fill price of $2.34 of credit per spread, which gives us an effective fill IV of around 49%. Now, remembering our benchmark RV that we used as a forecast of around 44.5, we're still well in the range to capture that edge. In a similar case, as with GME, if we go to the straddle and we got a fill price of $4.50 in credit per spread, we can see the fill IV we sold was significantly higher. And again, this is the trade-off we make. With uncovered structures like straddle or strangle, we are likely going to sell a higher effective IV and theoretically capture a larger edge. However, this comes at the cost of significantly more margin depending on your margining scheme. So it's always important to check both margin and your edge on the trade and see which one offers you the better potential return on margin. If we actually now look at the edge on margin, that is the dollar edge forecasted by our scenario analysis at our forecasted RV divided by the maintenance margin of the positions, starting with GME, we can see that it's a measly 0.17% for the short straddle and also a relatively small 0.3% for the iron condor. But in this case, due to the rule-based margining on GME, it makes more sense in this case, under this account's margin requirements, to actually take the iron condor. Now, if we look at the IBIT positions for the short straddle, we get a respectable 1.3% edge on margin and a 1.1% edge on margin for the iron condor. In this case, the difference is relatively small, and it would come down more to a choice of whether you are willing to delta hedge and dynamically manage the position, or if you'd rather have the static structure and not delta hedge. I took all four of these positions for illustration purposes and retroactively went through the work that should have been done in the beginning. But now that it's been done, it's clear that the GME position was likely not worth it on a return or edge on margin perspective, whereas the IBIT one was. It's also clear that we need to do this analysis to see whether or not the iron condor or uncovered structure is the better option in terms of capital efficiency. So it is now April 9th, and we can see that the GME implied volatility has fallen below our realized volatility forecast. Simultaneously, our V has ticked up a little bit, but nonetheless, this signifies we should be exiting our position, and so we'll go ahead and close those in the market. Simultaneously, on the same day today, we also had IBIT implied volatility drop significantly, and it dropped below our forecast of 44.5. And we're showing a pretty healthy profit here. So as a result, we're going to close out these spreads in the market as well. Taking a look at our GME positions here, we see the underlying price is right near the strike, which is exactly what we want. And our current P&L is around $328 for this 4-lot straddle. On the iron condor, again, right in the center of the condor, and we have a P&L of around $193 for the 4 lots. Moving to IBIT, we've gotten quite a bit of positive drift. And if we go down to the optimal delta hedge calculator, it actually suggests that to stay within our delta bands, we should be buying shares to hedge. But since IV has dropped below our forecast, that will trigger our exit condition. And instead of hedging, we'll just close out the position. And on our straddle, we've drifted a little bit, but our P&L is still around $444 for the 4-lot straddle. And then on our condor, we are at $282 for the 4 lots. We can see the results here of all the trades after commissions were included. On the IBIT Iron Condor, we were in the trade for 14 days, and the P&L was $283, or around 31% return on credit sold. For the IBIT Short Straddle, again, in the trade for 14 days, the total P&L was $453, or around 25% return on credit sold. For GME, for the Short Iron Condor, again, in the trade for 14 days, we had a P&L of $199, or 53% on credit sold. And finally, for the short straddle, again, 14 days in the trade, $317 of profit, or 40% on credit sold. In total, we sold $3,865 in total credit. Of that, we collected $1,253 for a total of 37.45% return on credit sold across all 4 positions. On the portfolio level, This was around 1.16% return in these 2 weeks, and annualizing that percentage gives us 34.7%. Overall, these trades went well, and we got the volatility drop we were looking for. That said, they could have just as easily gone the other way. It's important to remember that just because a trade doesn't make money doesn't mean it was a bad trade, and vice versa. The trades shown here were based on VRP, which is just one of the many strategies that I personally trade and that OQuants members learn and trade as well. I kept this section intentionally brief because the video is already long, but I wanted to give you a real-world look at how these setups can play out in live trading. If you want to learn more and about some different trading strategies, check out my other videos on the channel. And if you want to connect with a community of serious options traders, consider joining up at OQuants. Thanks for watching.